It's Friday, February 5th, 2021, episode 117. I'm Patrick Ceresna.
And I'm Kevin Muir. This week, we welcome back to the show Interactive Brokers Chief Strategist Steve Sosnick. We have a fantastic discussion about the GameStop saga, what it means for the market. Hint, Steve thinks it's potentially as transformative as the 1987 crash. And most importantly, Steve explains how the GameStop short interest became bigger than the float. Then Kuppy's back. He's calling in from Puerto Rico, but we couldn't miss a Kuppy's Corner in this crazy market. Then in Talking Charts, Patrick tells us to get dressed. He's going to show us his charts.
And this week in trading history, we go back to 1929 when the Fed tried to slow down the market speculation. And we end with the segments of No Stupid Questions and Skin in the Game. And folks, we might even drink some beers along the way. So stick around. We've got a great show. Lena, hop on. What beer are we drinking this week?
So today we're drinking Furnace Room Brewery's Chicken Man Pale Ale.
Now that wins name.
I picked this one. And or got these guys to sponsor, and it was definitely because of the can. Like it's just such a great. The Chicken Man, he's awesome. He actually looks like me. He's got the bald look going. He's got a Canadian shirt on. He's got a chicken on his bike.
There's actually a story on this can here.
Oh well, why don't you read it to us, Lena?
Pedaling his bike around town with his trusty chicken aboard, the Chicken Man, as he was known, has become iconic to residents of Georgetown. Although his identity is uncertain and his whereabouts unknown, his legend lives on. Make a trip down to Georgetown and ask the locals to tell the tales of how they remember him, or simply enjoy our pale ale in his honor.
Okay, well, let's keep it over.
Nice.
I don't know.
I don't like
Tastes
this
like
one.
something the Chicken Man might drink.
I like this one.
And it is from Georgetown.
Yeah.
So I couldn't get the Chicken Man.
True.
Maybe I'm lucky that I didn't, but I found a microbrewery down here in Barbados. They Dread Hop Brewing.
Nice.
It's the Round Rock IPA. It's a 6% IPA. And so I've been trying a couple of their different, because otherwise I'm already getting sick of the Banks beer down here, so I needed to change things up a little bit. But it's
their rating was about to head lower, like it was every week it was going to go down a little bit.
Every day it tastes a little more like old Milwaukee.
Okay, so what do you think of this beer you're drinking?
Oh, it's good, but we'll rate it at the end.
Okay, we'll rate it at the end. Let me do our magic disclaimer. And before we start, a big thanks to Christine, who gave us a whole host of different side effects to choose from. I've chosen my favorites, but let's get to it here. Nothing in this podcast should be viewed as investment advice. Listeners should consult an investment professional before making any decisions regarding topics mentioned in the show. Side effects of too much huddle may include the Yellen YOLOs, the Powell prophylaxis, and then finally, the Biden blow-off blisters. I like it. I'm a sucker for the alliteration. Like, I really am. Anyways, big thanks to Christine. And if anyone has any other ones, please pass them along.
That's awesome. All right. Let's get to our first interview.
It's our pleasure to welcome back to the show Chief Strategist for Interactive Brokers, Steve Sosnick. Steve, thanks for coming on.
Hey, it's always a pleasure to join you guys.
Before we start, you've done this gig before. You know the drill. You brought your own beer. What are you drinking?
I have, this is probably a summer beer, but I have Ripe and Cranky Passion Fruit Juiced IPA by the Stony Creek Brewery of Brantford, Connecticut.
Wow, that sounds like something Patrick would like.
Local.
Patrick likes the fruity beers.
Oh, there we go.
Nice. Well done. Well, cheers.
Cheers.
How does it taste? Is it a winner?
It is. You have to like a fruity beer, but it's good. I've had this. I should be drinking it on beach weather, not when there's 18 inches of snow outside. I'm sorry, 40 centimeters of snow. Yeah.
You guys got hit really bad. Did
we
you guys
got
shut down when that happens?
Well, this is, I guess, the beauty of work from home, right? Is I don't have to fight it. I mean, the one thing I really don't miss is about market making. Although there is a lot I miss, is like days where it's snowing and trying to fight my way into work to open the markets because I couldn't do it from home. And now, work from home, I just sort of like, it's pretty out there. I hope the plow guy comes. And,
That's funny.
Okay, so let's talk about the market. What's been on a lot of people's mind has been this GameStop, and you wrote a terrific article that walked through how it was that more than 100% of the float was short in GameStop. It doesn't seem like it's possible. When you think through it, you're supposed to not short unless you have a positive affirmation of the borrow, so it shouldn't be possible, but you walk us through how this could happen. So could you do us the pleasure of kind of giving us the synopsis and explaining it to us?
I would be glad to. It's amazing how much traction that single piece. It's probably the most read thing that's been on our website, certainly recently, if not ever. And I'll just give a plug to Interactive Brokers Traders Insight, which is where you'll be able to find it. The question was actually asked of me by a reporter, and she said, she's a reporter at Bloomberg. She was looking at her terminal, writing a story, and said, I see the short interest in GameStop at 143 or 144%. How is that possible? Or did we, meaning Bloomberg, make a mistake? Which obviously people at Bloomberg, don't like to process the idea that they might be wrong, which is, with the amount that everybody's paying for it, they really better get it right. And so, I looked into the numbers and said, wait a minute, they're not wrong. That is what's being reported by the exchanges, but how is that possible? That would imply that there's this huge naked short out there. And yes, naked shorting has largely been stamped out. You really have to have some sort of affirmation of a borrow. And if you can't find that, first of all, you're not supposed to lie and say you have a borrow. But if you somehow squeak out a short sale without actually really borrowing it, which can happen because you're told by your prime broker that you can borrow it, but they meanwhile lend the shares in the meantime to someone else. So it can happen, but you have to cover it. It should never be that way under any normal circumstance. So I asked our stock loan guys, how is this right? Is this possible? How can this be? And various of them, this is one of these opaque little secrets of stock loan land, which, by the way, is really one of the truly few remaining opaque areas of the markets. Good luck finding out really good detailed information about stock loan rates and short interest and things like that.
Yeah, but I'll just interrupt you for a quick second. The stock lending guys were always the shadiest of shadiest guys when it came to on the trading desks, and their Las Vegas conference, legendary for its debacles.
Yes, yeah. You know what I mean? I think of it this way. This is like, it's still one of the, for the most part, there are no real over-the-counter, blind markets, blind when I say blind to the public and kind of blind to each other, right, that exist. I mean, they spread sunshine into the municipal bond market, all these little corners, but somehow stock loan, it's still a world of, private dealing and stuff like that. And so when you have a situation like that, it's ripe for a conference like that. Let me put it that way. I remember the bad old days of the over-the-counter crime family conferences. Where, there was a lot of room for debauchery there, and so that this is one of the places where it can still go on, I guess. It sounds like I wish I'd gone to that conference. I will not call my stock loan department felonious. They seem like a very solid group of men and women, and I'm not gonna go that far as to cast any aspersions on them.
It was only me. That was a Market Huddle opinion only.
It's not a unique opinion out there in the world either. But I'm gonna stand up for my people. But basically, so in looking into it, there's an interesting little flaw, and that is that let's say broker A is long 1,000 shares of stock. Okay, he's going to want to lend it out, especially in the case of a GameStop, where it's hard to borrow, and therefore you're most likely looking at a severely negative interest rate, meaning you get paid to lend your share. You get paid over and above the normal rates to lend your shares, and so broker A lends it to broker B, who has a customer who sells it short. Those 1,000 shares are received by broker C, and they're delivered to him in good form and proper time because the borrow is good. Broker C, his stock loan department, looks at it and says, oh, I got 1,000 shares of GameStop. I can lend this out at a really good rate. Broker D says, calls broker C and says, have you got any GameStop? And because I got a customer who wants to sell it. And broker C says, yes, I do. Here's 1,000 shares. And he lends it to broker D, who sells it to broker E, who doesn't know if those shares are borrowed or lent either. And so it goes. And you can get into that situation. It's I don't know, reauthentication, rehypothecation. I probably don't have the right actual verbiage there, but basically the same shares can be relent in good faith. Of course, you see the problem in this scenario. If the customer broker A decides he wants to take a profit on his shares, that means all the other people in the chain have to then go out and scramble to get their shares back.
Right.
And that is the combustible nature of a short squeeze. But going back to the original premise, this is something I didn't know until I wrote about it, was that it's legal. I mean, let me start with the premise that short selling is legal, ethical, and an inherent part of the investment process. So I'm starting there. But obviously, naked shorting is illegal. But this is not naked shorting. This is just a bunch of independent actors all acting in good faith. It's weird, but it's
right.
It's true.
I think in your article you mentioned that there's synthetic longs, and so the synthetic longs create the real shorts.
Yeah, the synthetic longs are their own little situation where you can. You guys know as option traders, you can create a synthetic long,
right? But in fact, when you go and the next broker lends it out, like they think they're long, but they're not really.
Well, so that I guess it's different. It's different than calling it the synthetic long from what we think of it as a synthetic future. It's not really a synthetic long. Just nobody really knows if the shares are long or short. They don't come with a little flag. I would say if it was the old days where there was a cage, it's not like they have a little sticker on them. And it's in an era of electronic delivery that the shares exist in electronic form only for the vast majority of cases. There's no little flag that says these are long shares or short shares. It's just not.
So Oh, sorry. Go ahead, Patrick.
So, Steve, I was just when I was trying to describe it, I was kind of using the analogy of how our fractional reserve system works. Because when a commercial bank creates credit and that's deposited, it's there's not a differentiator between it being base money versus credit. In the end, money is money, and so that could be relent the same way that you described in the way that the short shares are sold into the market and sold that way. So I don't know. It's just the nature of how the financial markets work is the way I was just going to point that out.
It's an excellent analogy, Patrick, because that really is the situation. In the example I gave you, broker A had the reserve, the actual long shares, and they can get lent and relent, much as money is fungible, shares are fungible, and so it's not. And when I say fungible, not only just in the amount of buying and selling, but through the stock loan process. So, like money, there is a facility to get it relent, except the difference is, you don't have direct Fed supervision as to what is an appropriate amount of relending and reserve requirements that you need to hold. All you need to know is that you have, broker E had an assurance from broker C that he's got the shares. Broker C had no way of knowing that, he had been lending shares that weren't really owned. It's just, it's weird. But that's one of the pitfalls. It's a pitfall of short selling. There are so many pitfalls to short selling that all got exposed through this whole situation. And as much as I believe that short selling, it's not a wrong-headed activity. It's not for the faint of heart, because there are so many different ways for this to screw you up.
So, Steve, I guess we can agree that it wasn't nefarious, meaning that a whole bunch of hedge funds were trying to short it into zero, like what used to happen with the naked shorting, where if you could go and you just kept shorting unlimited amounts, you could drive it theoretically to zero. That wasn't what was happening. But at the same time, it as you say, it exposed a flaw. And one of the kind of feedbacks that I've gotten from some people in the hedge fund community is that when they go and they buy 5% of a stock, they have to file. And then when they have to go over 10%, they have to file immediately. And there's all sorts of warnings and things to prevent or at least to advertise that the hedge fund is buying all this stock or any sort of fund buying all this stock. Yet on the short side, there's none. There's absolutely none. So I was wondering, do you think that it's a good idea that maybe the same rules that apply on the long side, should they also apply on the short side?
I don't see why not. I mean, I think there's sorry, that noise you might have just heard was this giant ledge of snow falling off my roof past the window. It's warming up, so I'm getting these things flying off my roof. That's one sense of disclosure. Another thought would be, can you think of any good reason why the exchanges only release this data every 2 weeks, and even then on a lag?
Right.
Why not just put it out there? There's many different ways.
Sorry, I don't mean to interrupt, but I'll give you the answer to that, because you can spend many, many thousands of dollars and get that in real time.
But it's an approximation. The exchanges have it. It should be out there.
Right.
There are services that provide it. I'm well aware.
Yeah.
Yes.
And they're expensive.
They're expensive, and they do a good job. And they, I don't want to deprive anybody of a livelihood, but let me just ask the question that, since we're dealing with aggregated data, I understand why. In the case of a file, 13D or something, the companies don't do, the holders don't have to do it every week or so. But the exchanges know this information. It's there. And the fact that others compile it and sell it for a profit and are reasonably accurate with the information, I think that's great. It's important. But if the exchanges were serious, why not just put the information out there?
Well, just as a pushback, in Europe, they do require you to disclose large short interest. Yeah. And that's why you'll find that, PIMCO every now and then, or not PIMCO, sorry, Bridgewater every now and then you'll see some sort of announcement that they're short X, million shares of all these European names, and that's the disclosure. So it's not like other countries haven't gone down this road. And Sorry, and if we had that disclosure, maybe that it would have stopped all these hedge funds from herding in these one names, and maybe we wouldn't have had this squeeze like we experienced.
Sure. There's really basically little that you can say in the way of spreading sunshine that I'm going to say is a bad idea. So yes, that's a fine. Do them both. Do them all. Make the collateral increase. If the short interest gets above X, automatically raise the cost of the collateral at the clearinghouse. That'll put a stop to it. Or put a natural limitation on it. There's all different ways you can go, and it'll be interesting to see, because once you have Congress sniffing around, something will come of this, and it'll be interesting to see what it is. And of course, the fear of people in the industry is, that sometimes regulations that stem from a crisis are not as well targeted as they might otherwise be.
Right.
I'm being as charitable as possible. I don't really feel like, yeah.
So listen, I don't want to talk too much about GameStop, but why don't we just, you mentioned something about another issue in terms of the collateral. And one of the problems is being the certain fund or kind of brokerage firms that were ended up being the ones that got all the action in GameStop. They actually had to put more collateral up at the exchanges at the DTCC, which is the clearinghouse. Could you walk us through how that works and explain to us the pressures that a firm that was buying all sorts of GME might be under?
Sure. I mean, remember that a clearinghouse's job is to essentially backstop the system to some extent. They just as brokerage firms have to monitor the risk profiles of their customers and make sure that no single customer or no collective group of customers can threaten the firm's capital. The clearinghouses basically do the same thing. They have they've got risk monitoring, and they tell you the amount of collateral that you have to post based on the concentration of holdings that you might have and the risk profile of said holdings. And so in the case of GameStop, and I hate to keep picking on them, but it's such a unique situation, right? And so in that situation, a certain online brokerage firm, not mine, but one with a very popular app, found that there were ever increasing amounts of their customers buying this ever increasing stock that was incredibly volatile, going up, double digits, triple digits at a time. And so the clearinghouse, remember, there's T+2 settlement, so they see what kind of money that brokerage firm is going to have to put up on behalf of their customers. They don't have the money necessarily from the customers because of T+2. And so they said to the brokerage firms, we are raising the capital requirements on GameStop. We're going to require you to post not only the normal amount of collateral, we're going to demand excess collateral.
Right. And
that's to keep them from getting into trouble. And remember, the other problem with a clearinghouse, it's a little bit different in Canada, where the TMX owns the clearinghouse, and for the most part, it's dominated by highly capitalized big banks. In the U.S., yes, it's all the big banks are part of the clearinghouse, but so are a lot of smaller members, and the failure of one member in a mutual situation like that is borne out by the rest of the membership. And so a brokerage firm, let's say another online broker that has $9 billion plus in capital and manages its books very carefully, finds that they run the risk of being exposed to another broker through that activity. And the well-managed, well-capitalized broker can't model for what's on someone else's books or whatever capital cost may come of them, or the fact that now that the clearinghouse has raised the collateral requirements on everybody, right, because of concentration in one particular name by one or a few brokerage houses. And that's what happens. So what happens then is they put on the brakes. And I've looked into this. This is relatively normal. Normal's not the right word. It's not unprecedented. When silver had its one day wonder this week, I started to look into, obviously, could this become the next Hunt Brothers? Because not more that I thought it could be the next Hunt Brothers, but more like, okay, we've seen that movie before, and we know how it ends. And one of the things that brought that to a halt was the same kind of problem. Was the clearinghouses just said, no new positions. It's too much. The risk on our books is too great. And every pyramid, the Hunt Brothers short squeeze and GameStop in its own way was I'm saying pyramid as opposed to Ponzi, because one is one is unstable but legal. The other one is both unstable and illegal. So, GameStop was essentially became a pyramid. It required ever increasing amounts of new capital to maintain the stock where it was. It had the hallmarks of a pump and dump, but it wasn't, because there was no specific one pumper. It was thousands of pumpers. But
helped along by Elon and Chamath, but
that did, I guess those would be the Jordan Belforts in this story potentially. But I'm gonna say with, and it turns out there's other people who might have been a bit less pure than the driven snow in this in this situation. But let me just for the sake of argument, let me say that the vast majority of people were enthusiastic investors, some very knowledgeable, some less so, some, unencumbered by, most unencumbered by the kind of rules that hamstring someone who's registered.
Right.
And it turns out some might have been registered and talking their book in a way that they shouldn't have. And that's another one of these things that'll be sorted out. Where is the line between free speech and market manipulation? It's very gray.
Okay, so you mentioned new investors. Let's talk about this new generation investors. I was fascinated by the fact that somehow they got convinced that it was sticking it to the man to pay $300 or $400 or $500 for GameStop. And it actually made me really sad because, those of us that have been in the markets for a long time, we knew how this was going to play out. It was only a question of at what point does it peak out and how quickly it gets back to 20 or 50 or $100, but it wasn't staying at $500. Having said that, I kind of look at these new generation of investors, and in a lot of ways, those who are complaining about them, I always say, be careful what you're complaining about. The worst thing that could happen is markets get quiet and boring and not much fun. You have to admit that they're making things pretty interesting out there. I was wondering what your take is on this new generation, what you worry about, and what advice you'd give to people that are kind of embracing the markets as younger folk.
First of all, I love the idea that we have all kinds of new entrants into the marketplace, and overall, this is a good thing, and this is really what scared me to a certain extent about the mania that came up recently, because that's the kind of thing that washes people out of the market.
Yeah, I completely agree. That is actually what scares me as well.
And look, this is what the industry worked toward. If you want more of something, make it free. And we made it free for people to participate in the markets. And what that means is you're going to get people to participate in the markets. And what I want to say is, I think it's unfair to refer to them to new investors as dumb money. That's not right. Inexperienced money might be more appropriate. But you can't just write them all off as saying they don't know what they're doing. And I had this long discussion with one of my sons yesterday, who had been actually following our WSB page for some time. And I kind of made that line about, they're sticking it to the man. He said, no, that's mostly the most recent narrative. That really was just, let's say, in the past couple of weeks. Coincidentally, I don't think it's coincidental that it was, around the same time that you had Let's Stick It to Congress going on in the Capitol building. I don't think they're unrelated types of events. I think there's, there was a certain amount of anger in this. But the first wave of it, I think, were people who came to it relatively honestly. They were looking for community, as we all are. I mean, I'm sitting at home in my house, me and my wife staring at each other. It would be nice to have some community. But so I think people were looking for community, looking for ideas. I think it was natural that they, particularly for younger investors, to look someplace online, much as the new crop of investors who were newly emboldened by internet brokerage in the late 1990s went to Yahoo and AOL chat boards. I think that it was normal for this group to go to social media and look around for ideas. And, again, we can question the motivation of all the posters. Anytime, the single lesson I could give to a new investor is, if you see somebody posting about something, figure out what their motivation is, and you figure if it's on a chat board like that, they're talking their book. But I think the last part where it became sticking it to the man became, that was sort of that was in many ways the tip of the iceberg as well. And let me just say it's really an awful way. You're not sticking it to any, especially if you're the guy who went long at 300 last week. You're not sticking it to anybody. The guy from Melvin Capital, whom I don't know, who got the fact that he was able to get a multi-billion-dollar bailout. Nobody's bailing me out if I do anything colossally crazy like that. Right. I'm guessing he still lives better than most of the people who claim they were sticking it to him. Right. So be careful what that's a lousy investment. If you're doing it out of, investing is about self-interest. And I mean that in not a negative way. It's about doing what's best for you and your financial situation, and using the markets to that advantage legally and ethically.
So, Steve, one of the things that I've noticed over the past kind of decade, let's say, is that hedge funds, this is kind of the cycle that I see repeat over and over again. The smart ones find a situation that's legitimately cheap, something that makes sense. They put it on, they start buying it, and then they tell their friends about it after they've gotten everything they want, and the next kind of group buy it, and then slowly it starts to get out there, and it kind of spreads, and then next thing you know, it's going up because it starts to look good, and the technicals start feeding upon itself, and then by the end, the hedge funds that were talking about it, early on, are out publicly, shilling it. Like, they're getting on CNBC, they're talking about it, and that's when the public and everybody's getting in, and it might not even be the public as large, just kind of like the FinTwit kind of people that want to be like these hedge fund people. And over the years, I've seen this play out time and time again, where by the time that they're telling you about it, I think the original hedge fund that put it on because it was a smart idea is quietly selling it. And we've seen this with, hedge fund managers that have gotten on TV and they're crying about the COVID crisis. Meanwhile, they're covering their monster CDX book. And to me, this kind of GameStop with Wall Street Bets was no different, except that I guess the sheer size of the community surprised everyone. What do you think about that theory?
The two-word answer is yes, you're right. Or I guess that's 3 words. But yeah, like, why shouldn't the little guy play along? The big guys have been doing this for ages. Again, it comes back to the line between free speech and manipulation. There are specific rules about manipulation. You can, the hedge fund who puts on a position, then goes out to dinner, then goes to one of these idea dinners, I guess to the extent that they still exist in this environment, but goes to an idea dinner, talks it up, and gets the other cronies to do it, and talks it that way. Sure, it's a more rarefied environment than Wall Street Bets, but why not?
Yeah, it's no different than Wall Street Bets. It's just done with larger, more concentrated pools of capital. It's the same thing, in my opinion.
Yeah, that's why I'm not denigrating. That's why I'm not denigrating the idea of Wall Street Bets. I'm leery of the idea when it morphed into market populism. But I've been assured by many that this was not really what it was for most of the run.
Well, maybe it was for most of the actual diehard Wall Street Bet folks, and unfortunately, it captured the public's imagination. And I really put the blame squarely on Elon's feet. You look at it; it was going, but it wasn't until he went and said "GameStonk" or whatever he said. And I think that guy is borderline. I guess I should be careful what I should say.
Yeah, he's got a lot more money if we defame him. Let's put it that way. But what I will say is...
But I don't think that was a very responsible comment for him to make.
No. And on the other one that I think really appalled me was, I know Chamath is very popular among the WSB crowd. And when he basically tweeted out, I'm long GME 115 calls, and sort of set the thing in motion.
And then he pitched them. Then he sold it into to the rally.
See, that's that to me is manipulation. Yeah. If you tell people you're long and get them to
sell it to them,
and then sell it to them, that's manipulation. Hi, Patrick. Hadn't heard from you in a while.
That's my fault. I hog too much of it.
So Steve, I wanted to talk about this in a little bit of a bigger picture. Okay, so Jeremy Grantham was out many weeks ago talking about that this could be one of the most spectacular bubbles of our lifetime, and obviously the froth in the markets is incredibly thick, but one of the characteristics of this speculative cycle has been the utilization of these short-term call options to get that gamma squeeze going on the upside. And obviously, call open interest is hitting record levels during this period. And obviously, as a market maker, you've seen how this behind the scenes influences things. What's your take on this? Could this change the marketplace? Is this the kind of volumes that makes it hard to make a market? How do you envision the landscape evolving with so much concentration coming into the options market?
Well, I mean, again, I think it, as someone who's been in the options industry for decades, I think it's a good thing that people are participating. I think one of the most bizarre situations that will eventually work itself out, but it's purely a frothy phenomenon, is if you're buying weekly out of the money calls, those are literally the options with the worst odds. Or weekly out of the money puts, but weekly out of the money options, because they decay away so fast. And so in theory, these options should not be working for people. But since there's just this weight of money behind them, the gamma squeeze, as it were, it works. And, I think a lot of the people came to this, one of my, an argument again that I had with one of my sons is why is this not gambling? How is this different than sports gambling? And one of the things that I've been saying is it's different than sports gambling because the bettors can actually influence the outcome of the game. And because if enough people bet on, Apple going to 140 by next week, and I'm looking because Apple's 136 or so, 136 and change. If enough people buy enough weekly calls in Apple, the biggest company out there, they can influence this, ultimately the stock in Apple getting closer to 140, despite the fact that they're probably pretty richly priced and those options are likely to decay very quickly. That is a pure bull market phenomenon, and that we know this will end in some way. But the one lasting effect is, I do think that this is one of those seminal events that changes the way the market prices things, and perhaps the ultimate event of that nature was the 87 crash, and that was I was a market newbie for that one. And so I was not really, I was still getting, my role in the 87 crash was being on the international desk at Salomon Brothers and trading NASDAQ and over-the-counter stocks, and literally under orders just keep moving the prices and don't pick up the phone. That was my major role. Actually, the cool part was the next day, which people don't know about, which was when the market froze And basically the Fed gave a backstop to all the brokers and basically said, go out and buy what you need to buy. And that turned the market around.
Wasn't that also a function, though, Steve, of the problems with T+5 versus the futures? Because the Salomon Brothers and everyone was doing the ARB, because as the stock market crashed, they went and bought futures and sold stocks. But the trouble is the stocks were settling 5 days later, but meanwhile their S&Ps that they bought were marked to market. And so there was a huge problem that way with the cash flows.
Yes. Yeah. I mean, and I was at Salomon Brothers at the time. Again, literally like right out of the training class. So my role was pretty minimal. But that was a big problem. I mean, one of the things, and it was, it was kind of ironic that the person screaming the loudest, about T+2 was a guy who utilized the 2-day period to get himself a capital. I'm sorry, not a bailout, a capital injection. Let me use the euphemism of the time. But realistically, each day you remove from the settlement process, you remove a little bit of risk.
Right.
And this is a truism. So yes, T+2 is better than T+5. I'm not sure whether the right answer is T+0 or T+1. That's a discussion for another time, and will probably require more than just the one beer that I have on hand right now. But I have been at some of these conferences where they're trying to move to, where you listen to people who move to blockchain, my good friend who ran CDCC for a long time, I went to one of those where he presented. It's a theoretical construct that's very interesting. But yes, so the fewer days of settlement, the more risk that comes out. And in the days of T+5, that did present a huge risk. So it was like, there's a tsunami coming, it's coming, but you're powerless to do anything about it. So the Fed needed to come in and basically guarantee the books of these clearing banks, of the brokers and the clearing houses and the clearing banks, because of the settlement mismatch.
Right. But
where were we before I got on this huge tangent?
I'm sorry. I interrupted you, and I was going to say you were about to tell us about how that you think this is a seminal repricing of options. So why don't you keep along with that?
So what happened there was skews, and I was relatively new at the time, but skews were flatter then. From what I'm told from the older timers, I guess I'm an old timer now, but I'm going to call them older timers. And there wasn't this persistent skew that we see to puts that we do now. And that was because, the portfolio hedging that people did then, that the brokers sold them, was basically, don't worry, when the markets collapsed, you could sell more futures. Obviously, the right trade is to have puts on hand, not assume that you could sell increasing amounts of futures into a declining market. And so the lesson that was learned is it's better to hedge with options, since there aren't natural sellers of insurance via put options. Skews went up as demand for puts went up. And now I think what we're going to see is a more symmetrical smile, where the price of calls go up to reflect it. Now, it's not going to be as much, let's say, in the portfolio hedging, but if you're systematically raising the skews in all the components of SPX or NDX or SXO, whatever the index of your choice is, the large index is going to reflect that as well. So I do think that you're going to start to see a systematically higher pricing of calls relative to at-money options. Maybe it won't be symmetrical along with, symmetrically to puts, because you still have natural call writers that you don't have in terms of natural put writers. But I think you're going to see skew steepen, and that's the market's way of dealing with it.
So the Elvis half smile, the smirk, that was the kind of mainstay of mini option pricing, meaning that it was only the puts that would trade it higher, and actually often even the calls would trade lower as you went out of the money because more and more people were trying to write them. You think that that's going to turn into more of a grin, or more of a regular smile?
I do. Until or unless, markets evolve, at least in the short term. Now, people may say, wow, it's really in a low interest rate environment, it behooves me to write even more calls. And maybe then it balances out a bit. But I think that would be the natural reaction. We have seen it in talking to my friends who are still market making. They have been systematically raising their upside a bit. And I think that it's one of those things that it will persist until market conditions say otherwise.
Yeah, Steve, but that seems to have happened more on the hot sectors. Like, so if you do semiconductors or you look at some of these other cyclical plays, it's almost been a perfect smile on that skew. But even when you go to the S&P, that kind of Elvis smile still exists. Like, so, I mean, really, it seems to be like where everyone concentrates all that call buying to buy that speculative upside. That's where that's reshaping of the skew is occurring. But you think that this could happen more broadly on the entire market?
Well, I think so. I mean, obviously, Patrick, you're going to see it you're going to see it more in an NVIDIA than you would in an Exxon, for example. Yeah. But because of ultimately, if you see it in, Apple, Microsoft, Tesla, Google, Facebook, blah, 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 you're going to have to see it in NDX, because I've just rattled off about 50% of NDX right there. You're going to start to see it somewhat in SPX, because I just rattled off about 25% of SPX there. So it won't be perfect, but I have noticed it in terms of when I've charted, let's say, common chart I'll run is basically just term structure, 90, 100, 110 in terms of moneyness on S&P. For those of you who aren't used to the shorthand, 100% being at money options, 90% being out of the money puts, essentially, and 110% being out of the money calls, 10% out of the money in either direction. And we've always seen the 90s run hotter than the hundreds, right? We're always at least being since 1987, if not before that. What I have seen is, even in SPX, the difference between the 110 and the 100 has narrowed. Well, first of all, it's flipped in the front. It's actually is pretty relatively symmetrical, let's say a week or two out, because of the rampant speculation. But even going out like a month or so, I've seen the 110s and 120s get closer to the 100s. Then they have less of a discount to the 100s than they were before. Yeah. And that will, by the way, it's no coincidence. If I'm talking about 30-day options, specifically options between, 24 and 37 days to expiry, with a range of 100, with a range of strikes around at money. Am I referring to any specific index that might pop to mind? And so the fact that the 110 calls and 120 calls, again, talking percentage, go into VIX, same as the at monies and same as the 80s and the 90s, that actually is, I'm asserting that provides a little bit of a lift to VIX. Not meaningful, but I think that, the people who are really looking for, why is VIX, I heard someone on TV, why is VIX not at 17 today? Because it's going to take a little bit longer. I think the difference between the at monies and the VIX reflects out of the monies as well as at monies. And I think, the below market options pushed it up and the above market options typically pushed it down, but the above market options are pushing it down less. Right. And I think so you're seeing a different relationship now.
So, Steve, one of our previous guests, Harley Bassman, I don't know if you're familiar with him. He's the inventor of the MOVE Index. He's been owning long-dated, out-of-the-money equity calls. And I was thinking about this as you were talking, that if you are correct and we do get a repricing of the upside wings, which is what he's, in essence, telling you to buy, that he might, even if the stock market goes nowhere, might see his positioning appreciating quite dramatically just from the repricing of the skew.
It's possible. I mean, it depends what you buy the calls on. If you're, again, I think if you're buying them on, I'm trying to think of the dullest stock I can come up with. It's probably not going to happen too much. But
XLU, that's pretty dull.
Yeah, XLU is pretty dull. Yeah, so I think I don't know that you'll see it too much on XLU.
Right.
And I don't necessarily know that you'll see it so much on SOX, for example, where it's probably somewhat already priced in. But I think you might see that on something in between, for lack of a better word. Yes, so it's possible. You can see skews keeping, the higher skews keeping, being able to let the people make a little bit of a win on implied vol. That offsets some of the rapid, that's offset, I'm not going to say rapid decay if it's a long-term option, but offsets some of the decay, at least in the shorter part of their holdings. Yeah, it's possible.
So one of the things that you were mentioning is the fact that these young kids or the aggressive traders of this new generation love the 1 week weeklies. And you know what I think is extremely interesting is that when you go look in your, if you're a hedge fund or an institutional client, and you go to these big brokerages, they'll actually create programs for you where they systematically sell those 1 week, because just as you kind of have highlighted, over the long run, that has been a terrible trade. Like, you just generally do not, like, selling that makes more sense. But I'm kind of fascinated by the fact that although we sit there as older guys and say, this isn't a trade that works for the long run, I look at them and they keep seeming to steam us over and keep making money. And I find that kind of interesting. Like, I was wondering what your thoughts were about that, about this kind of phenomenon.
I think it's a product of the times. I think it's a product of easy money. Tina, there is no alternative. So, so think about it. And I'm going to think about it from, the U.S. investor the young U.S. investor point of view. Assuming that you maintained your job, which is a big assumption. Obviously, not everybody has been able to, maintain their income. So let me be clear. But the majority of people are not unemployed. But the majority of people with incomes below 75, below 75 and even up to 100,000, have gotten checks and are getting another check potentially. And at the same time, again, for the right reasons, you've also had moratoria on rent payments and student loan payments. You can avoid paying your rent and or your student loans without penalty in many states. And so if you've just been given free money, you look at your bank, which pays you nothing, and you look at the stock market, which has been going up, and you think of the excitement factor of, wait a minute, I can turn my stimulus check into...
It's a stimmy, Steve. It's a stimmy.
Oh, sorry, your stimmy into some... So I'll use the right lingo. Sorry. You turn your stimmy into something far more lucrative. Why not? Yeah. And so if enough people do it, it makes it right. Yeah. It doesn't make it correct, but it makes it work.
Yeah, that's right. And I think your point about that you're influencing the outcome of the game is the real part that people need to understand. And I think that older people have just been underestimating how large this group is. And I think it's funny that you're talking to your son about trading. I trade in a group of professional traders, and I must say, those with kind of young adult teenagers and early adults, we sit there and wondering what the hot stock is all the time. Like, that seems to be like all we do is ask them, like, okay, what are you guys talking about these days?
Yeah, I mean, I had my 23-year-old living at home for a while, and he was lucky in the sense that he still was employed. He was able to work from home. He wasn't getting the kind of hours he was getting. He's actually a comedian, but the way he actually earns a living right now without any comedy going on is he tutors he tutors SATs and ACTs and stuff like that, which is a pretty good gig, but he wasn't getting the same hours he was getting. But his lease in Brooklyn happened to end on March 31st. And so he spent the summer living with mom and dad, who didn't charge him rent, who didn't pay, who paid for every meal. There was no place to go out with his friends. He, because his hours dipped at certain points, he was actually able to collect, some unemployment along the way. So this was like a windfall for him. And he was not, and this is one of those situations where, it's always dangerous to extrapolate, one person into this. He actually was not actively trading the markets because he was under the same roof as his old fuddy-duddy father, telling him, why some of these options were bad bets. But he, he's taken a much greater interest in the market and has been doing more investing. And so the situation is right. And this is being driven by the younger crowd. But let's remember that is the same thing that really happened. Who were the people first adopters of internet brokerage?
Yeah. Listen, how different is this? Like, I was late 20s in the late 90s, and to me, I just feel like it's the same thing repeating. There's no difference. And for those who are getting high and mighty about these young kids doing something dumb and going crazy, like, get off your high horse. Like, every generation does this. Every generation eventually learns and stuff, and I good for them. Like, I think it's great that they're getting involved.
Here's the analogy that I draw. In the late 90s, investing was hugely democratized. Instead of having to call your broker who charged you 20, 50, 75, somewhere on my desk I have like the Muriel Siebert commission schedule from the 70s, which was a discount broker.
That's right.
I posted
the first woman director or member of the New York Stock Exchange.
First female member of the Stock Exchange. God bless her. And her stock actually somehow was one of the zombies that rallied last week too. I didn't know it was still out there. But this is not to knock her. This is just I have this, and it was like in my father-in-law's papers when we cleaned out his desk. It was just in there, and I saved it. I put it on Twitter once a while ago. Maybe it's time for a refresh. But all of a sudden you had all these upstart brokers charging $5, $10 a trade as opposed to $20, $50, $60, $70 a trade. And you didn't have to call the broker. You could do it yourself. And to me, the best commercial that ever ran in our industry was, and I think it was Ameritrade, but the old fuddy-duddy, I heard there's this internet thing, and he goes to like the young dude in the department and, hey, let's light this candle, man, showed him how to start trading on the web. And so you had this huge democratization of investing. Well, flash to now, and you had commissions go to zero. So instead of going from $20, from $50 to $10, they went from, a couple cents to 0 cents. You have fractional shares. You've made options investing way easier because over that time spreads have narrowed and there's many more resources in terms of how to trade options. And the message board. So instead of AOL and Yahoo, you're using Reddit and other means.
It's no different. The movies than the late 90s and all those old guys, stop yelling at clouds and just live a little and understand that every generation does this.
Yeah. Now the problem, of course, is the late 90s ended badly.
Yeah. It's just like GME. Like, you knew that it was going to end badly. The question was how high it was going to go before it ends. That was what the proximate catalyst would be. Yeah, that's all you know. Listen, before we go, we're running out of time, but I see that your son, if I got this right, is his name Charlie?
He is.
Okay, so he's got a website. So you gotta give him a little bit of a
Oh, you guys got to check. You guys got to check out Chazzy's World. He's on Twitter as I should know this offhand, but because it changes all the time. But if you look for Chazzy on Twitter, he actually does. He's not able to perform stand-up right now, but he's putting up all kinds of he's basically putting stuff online, sort of a weekly commentary. And right now it's at Charlie Sosnick is actually the real website. It's always like, but his website
I'm looking at it though, and I see that he's got a section called the petting zoo, and he performs with exotic animals.
The petting zoo this is one of the COVID problems. Is the petting zoo was a monthly show that he did at an underground club in Brooklyn, and it was getting real traction. It was literally him and him and a college buddy, who was also a stand-up comedian, and they would get other stand-ups, and they had an animal trainer who'd come, and so people would do stand-up with like a python around their neck, or like holding an iguana or something crazy like that, and it was working, and he was getting all kinds of interest, and then COVID hit, and they had to stop the show, and now the club went out of business. And this is the kind of stuff. So I do have another son, by the way, the one who was telling me about WSB. He does digital marketing.
I'm sorry, I didn't realize.
No, that's quite okay. He's not. He doesn't have a public personality the way that Chazzy does. And Chazzy writes. He's had some good screeds about McKinsey and the markets and stuff like that as well, from the point of view of a young satirist living at home with his crotchety old dad. He's back, by the way, moved back to Brooklyn, so he's not with the crotchety old dad so much anymore. But there's his shout out.
Well, that's awesome. So before we let you go, Steve, why don't you give the people a shout out of where they can find more about you and read more of your terrific articles?
Yes, thank you. You can find me, the stuff I write, at www.Traders Insight News. And that's the Interactive Brokers page. That this is basically where we put our research. And if you look in there, my stuff is usually pretty prominent. But if you search for my last name, Sosnick, Sosnick, you can then find basically everything I write. And I'd love it if you subscribe to our newsletter, or checked used an RSS feed to get our updates. And that's how you can find what I'm doing. And that is where you would find the short sale article, which is on there and gets a lot of hits.
Totally worth reading. And following you on Twitter at Steve Sosnick is also a must-do.
Thank you, Patrick. You could also follow me on LinkedIn. There's all different ways. I'm slowly coming to grips.
You're showing your age, Steve, by promoting your LinkedIn profile.
I know I am.
Right now, you're going to keep this thing alive.
Here's the worst part: is somebody older than me signed me up for Clubhouse this week, and I'm just like, I'm not going there yet, especially. But so yes, I fully embrace my middle-agedness or geezerhood or whatever you want to call it. But,
well, we appreciate all your valuable wisdom that you bring, and thank you very much for coming on the show once again.
It's always a pleasure, guys.
Take care.
And I look forward to doing this when I can come north and doing this with you guys.
You and us both. Weekend. We're looking forward to it.
All right, cheers.
Wonderful. Take care.
Okay, it's time for Kuppy's Corner, and gosh, if there was ever a Kuppy's Corner that people are looking forward to, it's got to be this one. Thanks for joining us.
Hey guys.
So Kuppy is actually on vacation for a change. I know it's very unusual. Why don't you tell us where you are this time?
I'm in Puerto Rico.
Nice.
You in Paulson, right?
Pardon?
You in Paulson.
Yeah, I don't even know. I don't know if he's here. I saw his home. It's big.
Well, the way your stocks are going up, it won't be long for you to have a home like that, Kuppy.
Yeah. Well, I mean, that's what I'm down here for. The right tax rate for me would be zero.
That's right. So listen, we got to find out. Lots of action. A lot of the things that you've been highlighted for a long time as potential squeezes finally came to be. Why don't you walk us through what you're thinking and what happened?
Well, I mean, what happened is pretty obvious. Everyone downloaded Kedem. That's KEDM.com. Sorry, I have to.
And for those who want to go sign up for free for now, go to KEDM and you can get Kuppy's weekly research report there.
So, sorry, I'm a walking infomercial. But everyone downloaded the short squeeze list, which is basically every stock with high short interest. And then they just went nuts. They bought all the shares, they bought all the call options, and they took the shorts and just killed them all. Like literally just killed them all. It was a brief moment of true mania as everyone stopped thinking and just targeted things with short squeezes. And we all know GameStop, and that was kind of funny to watch because you had two funds that were short about half the shares outstanding, and they kept basically pushing the stock down and shorting it. They were basically trying to get them to not roll their debt because the stock's at $4. People figure it's going bankrupt and it's hard to roll the debt, and they were hoping that they'd basically force it into a restructuring. And instead, they rolled the debt, and then there's really no reason for these guys to still be short. They had just been pile drivering it. And then they were arrogant and didn't cover, and it went parabolic. But, I mean, everyone knows that story. I think the bigger head scratcher is something like Tootsie Roll that doubled. I mean, I can't think of the last – like, when was the last time one of you guys ate a Tootsie Roll? They're repulsive.
I'm with you. I don't really understand anyone why that company's still in business, but –
I mean, I remember we'd go trick-or-treating, and even at like 5 years old, like you'd take all the good stuff, and you'd be left with all the Tootsie Rolls. It'd be like January or February, and you kind of worked your way through all the good stuff, and those are the last ones left over. And it's just like, am I going to eat these?
So funny.
And it's 6 months old. It's going to break your teeth by then. But anyway, like I know why there's a ton of guys short that. You have entrenched management that takes all the cash flow as salary, and it's a declining business. It's a great short. It's a great beta short. It's not like a terminal short, but it's just going to like great beta short for your long book. So it had a huge short interest forever. And then it doubled one day. And, that's, I think, the funny part of this whole thing. The whole world had this brief moment of mania. It's kind of like the EV bubble. And, I have a lot of friends who are deep value investors. And then they're like, hey, man, what's not up a lot with short interest? I'm like, but they're all crap. He's like, doesn't matter. I need some. It's like, okay. It was a weird moment in time. I made an unfathomable amount of money. We were positioned for a lot of these. My only regret is that I sold my GameStop 300 points too soon. It's stuff like that.
Yeah, but you're looking smart now. Listen, at $200, it was tough to say it was going to 500. You didn't know Elon was going to get there and GameStonk it.
I mean, the question I have for you is which algo, there's all these algos that scrape data off Twitter. Which algo was pre-programmed with GameStonk? Not GameStop, but GameStonk. Like, which computer programmer thought that up and got it right?
Do you laugh, but it's actually true that there are algos. Like, we watch it really carefully, and the Reuters algo, like if a news story hits Reuters, it'll move the stock a little bit, but not like when it hits Bloomberg. And the reason is that Bloomberg is much more watched and the algos are on there much more. So There's definitely people that are sitting around dreaming up those things and watching all these things and programming them in. Some, geek in that renaissance is just trying to come up with like, okay, what if Elon says this? What if Elon says that? And I got to figure there is somebody doing that.
Oh, I'm sure. If there's a way to make money, Rentec's done it.
So the market, it's unbelievable how quickly it shrugged off this huge increase in volatility. Like we had this kind of degrossing because of all the problems with the shorts, and then in a space of a week, we went right back on and regrossed the whole thing, and now we're sitting at almost at the highs. It's your Zimbabwe theory coming to life.
Well, yeah, I think we haven't talked enough about Project Zimbabwe because we've kind of joked that Project Zimbabwe is a period of time where they print too much money and stocks go up. But when you look at these periods and you look at Weimar, which had a more developed stock market, it's societal too. It's not just the fact that stocks go up every day, but people in society stop going to work. They stop, caring about the value of money because money's unlimited, and they all gamble all day in stocks. They talked about this during the Weimar. It was a 4-year period where basically everyone stopped working and they just speculated in stocks all day because it was so easy to make so much money. And what confuses me and boggles the mind is that there are people out there that actually still short stocks. No, seriously, I have a lot of friends and they're like, well, I've taken my exposure down on the short side, so we're going to be running we used to run 120.80, now we're like 120.50. I'm like, Why aren't you 200 and 0? Like what part of this is 100% going to lose money? Do you not understand? I mean, in Project Zimbabwe, we have 2 exposures that you could possibly put on, which is, max long and ludicrous, or, max long. That's my line. Max long and irresponsible long. There's only 2 exposures you're allowed to have. And I can't believe people have short books. I can't believe people are doing anything else. I mean, what we're doing a lot of, and I know it's not quite in keeping with Project Zimbabwe, but my feeling is that the market's probably not going to go up 10% a month. It's probably going to do like 2 or 3 a month, 4 a month. And so we can write puts in high volatility names, have a large basket of them, get paid 15 to 20% a month in terms of the premium yield. And so we're making 15 to 20%, and JPOW has my back. There's no down days, so we're basically, there's no tail risk to it. And so with a diversified basket of these, and a lot of them are kind of crap codes, we're making 15-ish yield. Like my Feb paper is written at a 16 yield. I'm starting to put on some March paper at almost a 20 yield. Because there's a bit more time to it. And
that's on annualized. That's just out to March, you're saying. Yeah.
Yeah. So, I mean, that's like 45 days. I'm getting a 20 yield. And so with those sort of yields on the paper, it's really illogical to do anything else. I mean, you and I were talking about this, like the GameStops. I was writing Feb 20 GameStops for $2.50. Like, one, I don't mind owning GameStop at 17.5. I mean, I owned a lot of GameStop at 17.5. I structurally think the business is dramatically better today than it was in December, because everyone's talking about GameStop. And I have a friend who has the scanner data, and he says their January is just like rock star blowout. They're going to have to pre-announce higher. And so I don't mind owning it because I think it's a better business today. And I get paid, $250 on 17.5 a risk. That's a really good risk-adjusted return for what was 3 weeks. Now it's 2 weeks. And so I'm just doing a lot more of that. I mean, we've taken our exposure way down in terms of like absolute longs. I mean, we're at 75 long, and then we have a huge option book.
Yeah. That's fascinating. And you're actually benefiting from this huge increase in volatility that we're experiencing, and you're just doing more, selling more of these puts as the vol increases.
Yeah, I mean, it goes in little cycles, but every time there's a blast of vol, we just throw a bunch more stuff on, and then it kind of implied vol comes in. I mean, what is GameStop implied vol now? It's only 300 instead of 600.
Yeah, I was 600. And it's like unfucking believable.
I thought I saw 1,000 at one point. Was it not?
Well, on the weeklies, like the fronts.
Oh, okay.
Yeah, like once you went a month, that it was about 600.
God.
That's like, what the fuck? Like, honestly, 600 vol. Like,
but it was too cheap. It was probably realizing well over 1,000. That's the thing about it.
On
it
daily,
seemed dumb at 600, but it probably was cheap versus what the actual moves were.
It probably, but I mean, 600 is a biotech stock that's going to announce the clinical data tomorrow. That's 600 vol, and GameStop just sells Nintendos. There's no event,
but the event risk is Elon Musk coming and saying GameStop.
But that's upside event risk.
That was unbelievable when he did that.
I mean, think of the guys at Maple Lane. Like, they just lost a third of their fund. It's like 401. They're like, thank God. Like, catch our breath, go get drunk, think it all through. 20 minutes later, the stock's up another $100 because of GameStop. I would have lost my mind.
One of the things that I saw some people talking about, how does someone lose, Melvin or one of these funds lost 50% or something of their assets, and you think to yourself, how does a fund lose that much? And when you realize if you have a 3% short, and the thing, how much did it go up? It went from 20 to 500. So what is that?
4 to 500.
$4.
It was a 100-bagger and I didn't
100-bagger. So your 100-bagger, think about that. You're 3% short. Like, think of the pain that's involved. Like, it's like I hear what you're saying, Kuppy, when you say is like, why are people short? Like, and I do think that this was a seminal moment for people to really reevaluate the potential for these squeezes. Because let's face it, you have been on this this theme for a while. You talked about the potential for a GameStop squeeze. And if I had asked you what you thought you could take it to, you might have told me 500 or $1,000. I think you might have. You actually said those things, but I thought you were insane. Like, I thought you were, drinking too much of your scotch.
Yeah, I mean, those guys built their model and figured to go from 4 to like 25 in a worst case scenario. But, in Project Zimbabwe, because money has no value anymore, prices have no tethering to reality either. It's why you got to have frauds like Tesla that are, Elon Musk, the richest guy in the world. Nothing matters anymore. So I don't know why you'd be short. I mean, I keep thinking of my very good friend who he lost a third of his fund short Kodak, and it was a 100 bips position. And he didn't even actually do any fundamental research. Literally, the only research he did was over-levered, dying tech company. Tech companies rarely ever turn around because you don't invest in R&D. You just keep getting further behind. He had 10 of these on his book, and it was a beta hedge. It was 1,000 bips beta hedge in 10 names. And so he asked his analysts, find me 10 dying tech stocks. And they put no mental thought into it at all. And he lost a third of his fund over something that really he wasn't even thinking about. And it's just terrifying when it happens.
Do you think that that's a function of the desire for so many people to have quote unquote hedged returns throughout the years? Like this hedge fund community, this was big, the long short, they all wanted, clients wanted this nice steady, 1% a month or 2% a month. And one of the easiest ways to do that is to get rid of the beta. And, when you're trying to get rid of the beta, you short some shitty stocks. But unfortunately, I almost think it was they ended up being a victim of their own success.
Well, they're all clustered in the same names. I mean, look, Julian Robertson, he put this model together. We were long 20 names, short 50. Obviously, you're going to be more diversified in your short book because of, supernova risk. But you end up with a return profile that is smoothed out, because in down markets, you're hedged the downside. Up markets, you're hoping your longs do better than your shorts, and you're kind of like 120-80. So you're like a 40 net long. So you're like, you have some long exposure, but in a flat market, you do well. In a down market, you lose less than the market. In a super up roaring market, you're not going to catch the spoos. But how often does the market go up more than like 20% in a year? It's a great model. But in the end, 1% a month with zero variability, that's Madoff. It's not real. It's artificial. And you can be truly artificial like Madoff was, or you can kind of like fake your way through it like a lot of these guys are. But in Project Zimbabwe, all you want to do is be max long. And, I think you have this pension fund world that looks at this as a yield replacement. And, they're not really they don't understand how the market works. They don't understand the risks of what they're asking for portfolio managers to do. But portfolio managers understand that they can market this product, so they just keep building this product that's structurally very risky, I think.
Right. So I didn't realize that, Kuppy, that was actually Julian's making, and he was the one who did this long 20, short 50. That was like, he was the pioneer of that.
Yeah, he kind of started that model. I mean, I'm sure other people did it before him, but he's the first one who took this to pension funds and said, look, we're going to outperform it in up and down markets, and it's going to be less volatile, so you can treat this as a yield replacement. And he was able to market and raise a ton of money. I mean, it didn't hurt that his numbers were outstanding.
Right.
But, it's the model, like a lot of my friends still say, well, I'm not hedged. I'm like, hedged against what? Like, what are you worried about? Like, no, seriously.
You crack me up. By the way, I was pulling it up on my Bloomberg here. The factor kind of returns. And if I go look at short interest for the last 7 years, meaning like if I pick all the different factors, it actually has been a terrible factor to invest, meaning it was a great short, meaning that it was like minus 19 point, almost minus 20 over 7 years and minus 42 over 15 years. So I think that one of the issues is that high short interest was actually something that worked for the longest time. And I think it was that's why there were so many people that clustered into it. It almost like was all, their success brought more of them to do it.
Yeah, well, you also had this funny facet. Look, companies with high short interest, normally there's something wrong with the company, which is why so many people are short in the first place. So, but shorting works really well when there's like 5 or 10% short interest. these guys, there hadn't been a supernova event in a long time. So guys were like, yeah, half the shares are short, but like, I don't care, like no one really thought about it as being scary. Whereas I always look at something with 50% short interest and wonder, wow, that's just terrifying, but it worked so long that you ended up with GameStop where, for a year, people were saying, how is it possible that you could have more shares short than outstanding? And like, we've discussed this before, how that's like, possible with how the clearinghouses are set up and everything. But if you were a short seller, like someone in your risk department should have been like, hey, like this is a little odd. Like this is dynamite here. Like you're playing with dynamite. And instead, Melvin's just like, now. Oh, cool.
Yeah, I think that's changed now for sure, right? Like it's, it almost seems like this factor might go in and start working again because no one wants to do it. So, Kuppy, well, you mentioned the KEDM, and it's been a great kind of product. For those who are interested, make sure you go sign up, KEDM.com. What else have you been flagging lately in there? What are some new ideas that we should talk about?
On stocks, honestly, not that much. Like stocks are generally overvalued. I bought some energy services stuff real recently because a bunch of them came out of bankruptcy and they cleaned up their debt and they're kind of cheap. But
so which names are you looking at? Like what are energy services? That's an actual name?
No. I bought 3 energy services stocks. I'd rather not talk about them because I'm still trying to buy them, though they go up every day.
Sorry, didn't mean to get you in trouble there, buddy.
Yeah. No, hey, after St. Joe, I'm kind of worried about talking about stuff.
Okay, just speaking of Joe, like you're still a holder. I see it blasting out to 53.5 today.
Well, 53.5 is on the way to 500, right?
So have you made enough to buy your house, your big, huge mansion yet in St. Joe? That's what I expect. With all the St. Joe profits, I expect the Kuppy mansion there that everyone can cruise on by and party at the pool with you.
Well, that's why I got to go to Puerto Rico because I got to figure out a way to cash out without paying taxes. Let me give you a stock ticker. Ticker's MCAC. It's a SPAC, so you're only going to probably wonder if I've lost my mind, and I probably have. But it's a profitable company. They're buying Playboy, okay? And this is something that I think three drunk guys can appreciate. Playboy. I own a few percent of the SPAC already. It's a reasonably sized position for us. But Playboy used to basically be Hugh Hefner's slush fund, and he was busy chasing girls and doing a pretty poor job of running a business. And anyway, he went to that great orgy or grotto in the sky, and private equity bought it.
Sorry. Sorry.
Don't
I wasn't expecting that one. You got me off guard. Sorry.
Oh, anyway, so private equity bought it, and they took a look at this, and they said magazines are dying. Pornhub beat the smut business, and they've pivoted it to a licensing business. And there's real adults in charge now. Ben Cohn, the CEO, I talked to him on the phone. He's a super sharp guy. They've been growing the licensing business about 20% a year. And that's just like putting the bunny on stuff, okay? Putting the bunny on clothing, and they have a furniture line, and they have like dildos, and I mean, go to the website. It's crazy all this stupid stuff they put a bunny on. But it's growing 20% a year. It's trading for less than the contractual license revenue that they're going to earn until 2030. So you're actually buying it for less than the expected earnings, and that's the minimum contractual revenue. And they've been beating the minimums each year. Plus, it's growing. The price is wrong for the shares. It's a super small SPAC. It's 5 million shares outstanding. I think they chose that on purpose because they want to get public and have a currency to roll up other things in the sex toy business or whatever. I mean, they just bought a chain of those stores. Well, I've never been one, but the sex stores where
oh yeah, I did not. I've never been to one of these.
You know those stores?
Have you guys?
I've never been there though.
I'm wholesome. I'm an alcoholic, but I'm wholesome.
I'm a wholesome alcoholic.
Anyway, let's not talk about the products. This is a family show. But Anyway, they bought a chain of sex toy stores. They're going to put their own branded product in, but he's going to do some smart things on the private equity side. But you're coming into this, I think, at a single-digit earning multiple that's growing fast, led by a guy who's looking to basically buy into businesses that normal PE can't touch, like a chain of sex stores, and buy them at a very low single-digit cash flow multiple, and then increase the earnings by putting their branded products in. I think it's super smart. And I don't know. I own it. The ticker's MCAC. I mean, I bought mine about 10 and a quarter. We're trading like 12 and a half today. So you're not paying up too much. And the deal hopefully closes next week. And, you're buying it for less than the contracted royalties. And royalty businesses tend to trade at, 20, 30 times and not like 6 times. It's the wrong multiple. But it's a SPAC, and it's a profitable SPAC. So it slipped through the cracks because it's not like EV or it's not, space fraud or anything like that.
I'm not sure. I'm not sure how ESG compliant it is either.
What do you mean? Every stock goes up.
So Kuppy.
Wait, Patrick, are you going to change the subject? Because I got more to say on this.
Okay, all right, go for it.
I'll let you change the subject, but I just want to say one thing.
Go for it.
So you're talking about the grotto in the sky, and first of all, do you get the mansions with this? Like, are they buying the mansions? Like, do they still?
No, PE sold the mansion. They got rid of a lot of the legacy Hefner stuff. Oddly, they own his own intellectual property, so like they can use him, his personal image on products and
because that's really what you want is a creepy old man that's like doing that. Having said that, I want to tell one story. Wait, I want to tell one story about this.
Halloween before and dressed up all your female friends as like slutty bunnies. You haven't done that for Halloween once?
No, the wife.
It's on my to-do list. It's on my to-do list.
Not. I tried it. I gave it a whirl. She just was not into it. I have a buddy that was legit married to a Playboy bunny. Legit. I wouldn't call him a buddy. A guy I know, a trader that I met. So you can't at some point you're like out drinking, you're drinking too much. You got to ask them. You go like, okay, what's it like and stuff like that. You ever been to the mansion? And I have to just pass this story on. So he says, yes, I've been to the mansion, and he said it was disgusting. He said it was so gross. It was like I didn't want to go in the. I said, "Did you see the grotto?" He goes, "Yeah, I saw it. I wouldn't get in there, with someone else's body." And then the worst part about it, he says to me, he says, "You know what? It was like terrible. I basically spent the whole time stopping Jeremy Piven from hitting on my wife." That's like he said. Anyways, I just thought that was kind of funny. Like it is the mansions and that whole image of the Playboy thing. It is kind of gross in terms of like it was not the nicest thing. And I would love to hear some stories of people that have actually been there and experienced those parties.
Yeah. No, I wish I could say I've gone, but no, I'm not on that A list. But in any case, Playboy is one of the 20 most recognized global brands, actually, which is odd. I mean, it actually is very iconic in Asia, in India, and, it's just been underused in terms of licensing and royalties and stuff. So I think there's a huge potential. These guys, the PE guys took it over, but they couldn't really clean it up until Hef died. So they've only really had like 3 or 4 years to kind of work with it and grow the business. And they've done a great job in a short period of time, while still dealing with a bunch of legacy baggage. Anyway, that's one stock pick I threw out you guys.
Sure.
So Cup, what I was noticing at the end of the year, St. Joe's took a break and just like started trading sideways. But in the last week, we had came to a nice breakout here. Like, I mean, we're heading to a fresh high. What's your take? Is this still autopiloting up to your $100 target?
Yep. I think it's going way past 100. I mean, 100 is like a short-term target, but I mean, 100 would be less than the value of the land. I mean, I'm just looking at this and saying all value stocks trade for less than book value, so why should this one trade for more than book value? But no, I think ultimately this is going to go to a few hundred, maybe, with a little bit of inflation, a few thousand. Right. I'm a huge believer in this. I have not sold a share.
Right.
Well, that's great. So, listen, Kuppy, we'll let you get back to Puerto Rico. You did share a picture or two. We'll make sure we include them in here. Are you having fun? Like, is there a lockdown, or are you just able to do whatever you want?
It's an odd lockdown because there's a curfew at 11, which is bizarre. But
because the
COVID
goes to sleep at 11, or comes out at 11. Sorry, the opposite.
Comes out at 11. It's science based, right? But no, it's mostly open here. These guys took COVID a lot more seriously than Florida, but Florida kind of just doesn't believe in COVID. So it's hard to say. But no, I'm enjoying it actually. I'd been to Puerto Rico a few years ago, and San Juan's kind of a dump, but still kind of a dump. But the rest of the island's beautiful, and we're enjoying ourselves.
Now, in Florida, it's really cold. You left just in time. I've heard that it's under 10 degrees. I don't know, what is that for you guys? It's like 40 or 50.
Yeah, well, I mean, my apartment doesn't have heat. When it gets cold like this, it does this about every other year for like 2 nights.
Yeah,
we'll turn the stove on, and my wife and I will put on like all our sweaters, and we'll just like sit in front of the stove drinking because it's the warmest part of the house.
You realize that's how people die. Like a carbon monoxide poisoning from that. Guppy, God. And you guys are like you guys are the cold. You guys are the wimpiest things. Whenever I go to Florida in like at Christmas time, or and I'm there and I go for a swim, I'm like swimming, and it's like maybe 15 or 20 degrees. So what's that for you guys? Like 60 or like 50 or 60, and and sure enough. Like, I'll see some Americans come by, bundled up with their stuff, and they'll look at me and they'll go, "Canadian, eh?" It's only the stupid Canadians that are swimming. That basically, they just kind of laugh at us.
Wow. Pretty much. Yeah, no, about under 60 degrees, I don't go outside. Like, I really don't. I try not to.
Yeah.
So you only come up to Toronto for 1 month a year, right?
That's right. Do you honestly like at 60 degrees? Is that cold for you? Like you're like literally like that's a big deal?
Not 60, but below 50, like in the 40s, I will have my winter jacket on. I'll have my gloves on. I'll have my scarf, my hat. Like I'll be bundled up, and like I'll run into whatever I have to do from the car.
Really? Okay, wait. I got to figure out what this is.
That's like 50 is 10 degrees Celsius.
Yeah, below 10.
Yeah.
Oh God.
Oh my God.
It's a nice
you're soft.
day.
Yeah, it's soft.
Listen,
do you realize
it was 5 degrees the other day? It was 5 degrees the other day in Toronto, and everyone was out walking because it was so beautiful. Like we were all outside walking.
I remember once they thought it was going to snow a little, and they canceled school. And there were like a couple of flakes we saw in Miami, and my wife and I were like, "Wow, I've never seen snow." But they canceled school for the whole week. They just like kids can't go outside in this stuff.
So wait, has your wife never seen snow?
Oh yeah, no, she's seen
no, because you've taken her places and stuff, right? But there must be people that have never seen snow that have like lived their whole lives in South Florida.
Right. I mean, it doesn't snow like in 17 years. I think twice I've seen a few flakes, and you kind of look at it, you'll go, "Wow, this is freaky."
That's funny.
Anyway,
okay.
Puerto Rico.
Anyways, we'll let you get back to enjoying Puerto Rico. I hope it's nicer weather there than it is in Florida, and that you're not bundled up around the stove, dying of carbon monoxide poisoning.
No, we have one of those fancy electric stoves with like 19 buttons. I still don't know how to operate it. I barely know how to turn it on, honestly.
That's funny.
Okay, buddy. All right, anyways, thank you very much for tuning in. Why don't you tell people again where they can find KEDM and what it is that you do there? Give it the one last little push.
KEDM.com. It's my event-driven monitor. It's free for a couple more months. You really should sign up if you want to do some event-driven trading. We track over 20 strategies, and we're actually looking to onboard a few new strategies very soon. So I just think there's a lot of alpha out there and event-driven, and happy to share it for now.
Well, great. Thanks a lot for joining us,
Kuppy.
Thanks for making time.
Thanks a lot for having me.
Enjoy the rest of your vacation, and we look forward to hearing where you are the next time we talk to you next month.
I'll probably be working in Miami, actually. I do have to work. I have a job.
I'm a seller of that, Kuppy. I will say that you'll be somewhere else.
Probably.
Take care,
all right,
bud.
guys. Talk soon.
All right.
Okay, bye.
Take care.
Later.
Okay, Patrick, it's time for Talking Charts. What do you have for us this week?
Well, before we get to the actual charts, let's talk about the top 3 things from last week, and then we'll get into the top 3 things to watch this week. So, first thing we talked about was this a fake out or a breakout on Bitcoin to the upside was the number 3 that we did, and well, I think the jury is somewhat still out. The interesting part about it did strengthen. I mean, we're almost at 38,000 on the upside. But I was hoping for a little more of a decisive move to kind of really clarify that. I mean, in theory, we could come with a red candle on Monday and we'd be asking the same question as we did. I don't know. What's your feeling? Do you think Bitcoin's going to finish that move? It really hasn't shown its hand here.
At the same time, I feel like maybe Bitcoin hasn't, but a lot of the Bitcoin surrogates, like you go look at the MicroStrategy pushed up to new highs. A lot of these bits in the sky companies are flying. So to me, it actually felt quite bullish.
Right. So number 2 last week was have the global equity markets begun a correction? And the answer is no. The answer is
decisively not. It's been actually amazing how quickly it was the selling was met with buying. Just a wall of buying. Crazy.
Everything just stalled right at its 50-day moving averages and turns. So here's the MSCI World Index making a fresh high. The Euro stock punched a little bit to a higher high. I mean, maybe there's still potential for prairie dogs on this stuff, but the Nikkei is almost right back to its previous high. The interesting India Bombay fresh high. Even the China A50 is attempting to break out to a higher high. So a global correction has not begun. And number 1 was, are there Reddit kids going to run silver? And the answer was that was quite the fake out, wasn't it?
Well, yeah, they got hammered in the silver.
First of all the hype did create quite the gap, right? Oh. We were 10% up on silver and just on the open, and it kind of held up there, but then it just started to give it all back.
I have a theory that it was basically the weekend of everyone talking about it, of all the excitement happening, and basically I think that
the FOMO
anybody
traders
that was willing to sell silver just backed off. And they said, let's just see how high we can get this and we can open it. And it was the ultimate just kind of opening almost at the highs of the day and then just being met with selling all week long.
I think we could circle back to precious metals in a moment, but let's actually review the top 3 things to watch for next week. And, while silver did pop and gave it back, silver is not in really a downtrend of any sort. But what did happen was that gold never participated on the silver pop and broke. And while it's easy to kind of look at that previous low from November, December, as still not having been broken on the downside, gold can't seem to get any tailwind, and it just feels like it's rolling over, and it broke below its 200-day moving average, and the price action is very weak. Now, I'm a gold optimist, and so I'm looking at this a little positively, which is that this will wash out all the weak hands, kind of give it the base that over the next couple of weeks, and it could turn positively from there. But there is a red flag that we broke below that 200-day moving average. What's your take on gold here?
Well, I just see the headline that you wrote. How low can gold go? Even though you say you're an optimist, you sound pretty pessimistic to me, Patrick.
Well, it was a breakdown candle, so it was meant to be a question. It's just about how low will it go. I'm asking it in a non-negative way. Oh, whatever. All right, go ahead.
Anyways,
what's your opinion?
I think gold heads higher. I think that it's washed out, and although everyone's quite bearish on it, I really do believe that everyone that wants to sell has sold, and well, not everyone, but a lot of people that want to sold have sold, and let's face it, Bitcoin's attracting a lot of the attention that would usually be garnered towards gold, and one of these days Bitcoin will stop going up, and maybe they'll return to the gold. Anyways, I refuse to give up just because we crossed the moving average and there was a large red candle.
my kind of scenario that I would be watching for just to see what, obviously I'm not predicting it, but like if gold had just one kind of clean washout down to like 1750, makes that low below the November low, and everyone, like it's the big headline that gold is breaking down, just washes everything out, and then a big reversal, it would be good kind of to have that kind of sentiment shift. But I mean, without that silver pop even causing gold to uptick in any meaningful way, while I agree with you that gold can go higher, I think it might not be a February story. It might be something that we have to wait till March or April to really see that turn up. Anyway, number 2, the VIX. Will we see it in the teens?
Yeah, I'm a seller of that. I think that volatility is going to be high for a long time. And, well, I guess, we're not that far from the teens. I shouldn't say that. If it goes down another, what's that, $1.18, $1.19,
yeah,
it's down in the teens. But in terms of, I think that'll be the low. Maybe 19 will be the low. I think that we're at a permanently new higher. Well, I shouldn't say permanently. Anytime anyone says that, you should always be worried. But I do believe we're in a higher volatility regime, and that the old days of VIX at like 12 and 10 and 9, like we saw in 17 and 16, is long gone.
It's pretty amazing that pop and drop we saw on the VIX. So like that one day slam higher that shot the VIX almost up to 40. And then they gave it all back in the entire week. And so whenever you see this kind of rate of change of VIX on the way down, it's always going to be really interesting whether that 20 level becomes the floor like it has so successfully done in this post-coronavirus period. And so it's definitely something I'm watching next week. Anyway, and the last thing I think we have to really watch for, Kev, is what the inflation numbers look like next week, right?
I think one of these days, Patrick, we're going to have a surprise to the upside on inflation. I know that everyone thinks I'm insane, but I think it'll come. And so I'm going to stick that inflation number in the top 3 things to watch every week until it actually shows up.
Even a broken clock is right twice a day.
Exactly.
So if you just keep repeating it, the one time it happens, you can always just say, "Hey,
That's
I
right.
told you so."
I'll be like most of those FinTwit bear gurus that everyone worships. I'm just as bad. I'm the FinTwit kind of inflation guru.
Yeah, that's my condolences to you, buddy.
More like knob, the inflation knob that keeps calling for it. No, but Patrick, I think there's a lot of signs that there's inflation and a lot of stresses in a lot of different areas.
No doubt.
Lumber, housing, a lot
just
of
commodities in general, oil.
Yeah, I think like it'll just come out of nowhere, Patrick, and everyone will be like, "Wait, where was this? Why did this come?" And maybe it's not this month. Who knows? Like, it's difficult to say, but I definitely think the surprise will be to the upside. And I think the market is going to have a lot of issues when it finally comes, but that's a story for another day.
What if, I want to push back on you a little bit. Like, what if we do end up having a surprise where the stock market starts some sort of a deep correction? Jeremy Grantham was talking about that, like some sort of like a speculative blow off, and that asset deflation kind of takes the wind out of the economy sales. Like, I mean, could that just prolong your little inflation narrative another year or two and have you once again?
No, because I think that what's driving inflation is not a trickle-down economics from the stock market gains. I think what's driving the inflation is a function of fiscal getting into the hands of people that are going to spend it. Yeah. So I think that anybody that's sitting there staring at the stock market and worried about inflation going down because stocks go down, they're the same, bunch of people that believe that trickle-down economics works. It doesn't.
It's growing on me that inflation will come, but I still actually think it's a reasonable chance that it's early. Anyway, we'll see. The
only thing I will say that you are correct is that there's a whole bunch of trades that are put on based upon what I call reflation. And those reflation trades might come down in price, but that doesn't mean that inflation will come down in price. And yeah, at the margin, maybe they'll send crude oil down, they'll send some things like that. But I'm expecting this to be a lot longer term effect, and any sort of move in the markets would just be a temporary in nature.
So this is the inflation expectations ETF that RINF, and you can see that this has just been a straight line higher. And like we were just saying, this could just take a dip to the downside. That could cause all those yield curves to kind of have some corrective phases, break evens to back off. And you know what? I still think that that's entirely possible to still play out this year, even though, central bank and fiscal policy clearly are pointing toward inevitably that inflation narrative to finally come to fruition down the road. Anyway, let's talk some charts though, Kev. The S&P 500, just like those global indices we were showing earlier, breaks to a higher high. This was not the big market correction that we were looking for, or at least I was looking for.
I was too. I thought that basically the increase in volatility would create a negative feedback loop, and as long as volatility stayed high, you would get some Vanna selling, and it would kind of spiral on itself. Yeah. But it's shocking to me how much it was, met with buying. It was just unbelievable.
For sure.
It was like there was, some monster client sitting there with the biggest buy ticket, and when they came up Monday morning and they just started buying, and they've been buying all week.
Yeah. And so I want to look at some of these other things that continued to work. And this is the Bloomberg Commodity Index futures. And there, the commodity index, fresh high. I'm certainly thinking that the oil is influencing this because it's such a huge weighting into this index. But a fresh high, right? It's just going. Crude oil, $57. Now, what's interesting about crude is that it's approaching, get rid of that minus 40 print, but it's approaching a lot of these consolidation zones from 2019 where crude oil traded pretty much sideways in that mid 50s to $60 range. And so as we approach this, it'll be really interesting to see whether this becomes a point of resistance and all of that volume that transacted in that zone stalls the advance. I don't want to say something bearish on the other side, but necessarily just runs and bumps its head along there and becomes far more range bound. It'll be interesting to see if that happens. The other thing that was interesting was that turn higher in nat gas. This is a continuous contract. Maybe we should be looking at that March contract, but it really seems like it's a rounding bottom, rolling up. And the question is, now that the weather seems a little bit colder, does nat gas have one more little spike going before kind of calming down into the typical seasonal pattern it has? What's your take on nat gas?
Oh God, you didn't tell me you were going to talk about this. You're going to gooch for my trade. You know me, I'm always bullish nat gas.
All right, we'll change it. We'll change the topic.
I go and I give my my donation to the nat gas pit every year. I give to the nat gas traders because I'm
the widow makers
bull. It's just I don't know. Patrick, I've lost the ability to talk about it. Because I have so many bad calls.
All right, so but look at this breakout on copper. Now, you know what? I was looking for a correction in copper as low as 3.25. I just thought it was due to give it back, but I remain a commodity bull. So I was, was looking for that to be a buying opportunity. But look at that breakout candle today in copper. It'll be really interesting to see whether copper has enough gas in the tank to punch $4 on the upside. That's for sure something I'm watching. Are you still generally bullish on copper?
For sure. I try not to look at it. This is my one trade. I tell my subscribers that if I ever start trying to get cute on it too much, they should remind me that I said copper for the long haul and that I shouldn't trade it.
But how do you put it on then? Are you just rolling futures at this stage?
Yeah, you just roll them and try not to look.
Uranium. Obviously, we have to talk about this because obviously some news from the U.S. government towards uranium created a very positive reaction, both on the Participation Corp, but a lot of other uranium companies. I'll just use Cameco spiking higher. Is this the rolling bubble, and are these uranium plays finally going to get some tailwind? The chart's definitely broken out.
I sure hope you're right, Patrick, but The Cameco chart doesn't look that great. They tried to squeeze it. The Wall Street Bet folks seem to think that there was a large short position and they jumped all over it. But again, it was met with selling. I'm hopeful it's just quiet and then we're going to wake up and it's going to just grind higher. And next thing you know, it'll be much higher. Oh, I know a chart you should look at. An EFR in Canada, which is, I think is it triple U or quadruple U in the States?
Energy fuels.
Yeah, energy fuels. Look at that thing.
Oh, yeah. Yeah, fresh 52-week day.
Now there's a good looking chart. So maybe that's leading the way. Maybe that's what we should be looking for.
Yeah, that is definitely a nice looking chart. What's interesting? Let's talk grains a little bit. Like corn keeps plugging higher highs, but wheat and soybean have kind of stalled out a little bit. Do you think all the grains have enough gas in the tank to go higher? I mean, these charts still are very bullish. I mean, they've just been consolidating for a couple of weeks now. Do you think there's one more leg here?
No, I would love to see them come in, Patrick, so I can buy, like I actually did reduce my size, so I would love to see them come in so I can buy them again. And I'll let you tell me your technical voodoo magic of when I should buy it. So I'll wait for you to tell me.
Oh, sure. Which one? Which one are you waiting on? Wheat, or are you waiting on?
You know me. I don't know any of the difference between them all, so I just buy all three at the same time.
Well, you know what? Just buy and close your eyes. That seems to work very well for you. So, I'm not even going to give you any.
It seems to work for everyone in this day and age. Buy anything, close your eyes, and eventually it'll go up.
I was going to look at lumber, but I don't like the continuous contract. Let's look at the March contract here. Lumber just keeps going. We've highlighted this a couple of weeks ago, and it just hasn't quit. I mean, the target that I have is up to the 1,000 level, and it just doesn't want to quit. But I mean, at this stage, it's kind of late to buy it. I mean, I think it should be almost profit taken into 1,000 and not chasing it here. But what a run this has had, eh?
There you go, folks. You just heard it. Patrick says it's too late to buy it, which means it's going to double again.
No, if you have it, you still hold for more. I'm just saying there's not a lot of asymmetry in chasing, buddy. Just chill. God, you're too much. Anyway, but the other stuff, it was interesting. I'm just looking at the other commodities. Have a look at this chart on the cocoa futures. They've been nicely basing, rolling up. Are we going to get a new breakout in cocoa? And another one that was interesting was looking at coffee, which had a really nice breakout. It's been just trading sideways along those previous highs. There's no such thing as a triple top that at least I know one person has told me that before. I don't know who is that that's always tells me that.
I don't know. That guy sounds like an idiot, though.
Yeah, it does. Yeah. And so... So it'll be interesting to see whether a couple of these other commodities will make a run, right? And the last things I wanted to touch on, let's start with looking at these airlines. I'm just going to use the Jets ETF. And looks like after them consolidating for much of the start of the year, December and January, they're consolidating. It looks like they're rolling up for a breakout. Are these airline plays going to catch some tailwind here and go for a nice punch higher? I think that's going to be a really interesting to watch. And some of the other ones, look at the casino stocks like MGM. It looks like Vegas is back, buddy.
Yeah, it almost like it's the reopening trade has come right back. And actually, I was going to talk to you about that and say, was this a function of some good news in terms of the U.S. rolling out the vaccine in the market, trying to look ahead and saying, you know what? They're catching up in terms of, I think that there's more people getting vaccinated than getting COVID. So I think that there's the market's getting a little excited about looking through and saying, I could see the situation where this summer things will be rocking again. I still think this 20s, man, it's going to be like the 1920s, 100 years later, it's going to be wild. When everyone gets, when everyone gets their vaccine and we can all go out and party, it is going to be just the rockingest parties. That's going to be the roaring 20s.
You're going to bring your cane out by then?
Yeah.
Anyway, but take a look at Carnival Cruises. It's consolidated. It looks like the airline stocks. It's just ready to roll up. It's interesting because out here in Barbados, looking out my window, you can see the empty cruise ships just trolling. They have not come back yet.
But they go into the other little ships and saying you're not that smart after all, just saying mean things to them. They're just trolling the little ships.
That's exactly what they're doing. Yeah. Anyway, but you can see that these it really looks like they've really based here, right? And so it'll be really interesting to see whether or not all of these things turn up. Anyway,
I'll just say one thing about those things. I suspect that even when we get going, that there was so much equity issued and so much debt and so much like destruction. I'm not sure that that's where you play it for a reopening. I don't know.
Well, you know what?
I might be wrong.
You have to trade it. You shouldn't be a long-term investor, right? Like, I don't know. Like if there's when the market decides that something is going to make money, then you have to stop trying to use fundamentals, right? Like it's like you're trying to use fundamentals on GameStop, right?
That's right. If anything, this week has taught us that we shouldn't be using fundamentals.
Yeah.
All that matters is the charts. All that matters is the charts.
No, it's money flow, buddy. It's about it's about what's hot on the internet. Anyway, that's all I have for you, Kev.
Well, sounds good. Thanks for sharing with us. Okay, Patrick, this week in trading history, what story do you have for us?
Well, since you mentioned the Roaring 20s, well, we have to go there, buddy. And so it was February 2nd, 1929. The Federal Reserve tries to cool off speculators as that 1920s bull market reaches historic heights. They announce a new policy to try to prevent the reloaning of reserve funds to brokers. Now, at the time, Roy Young was the chairman of the Federal Reserve Board. During the preceding period, there was confrontation between Young and at the time the Federal Reserve Bank of New York chairman, George Harrison, on how to curb speculation that led to the stock market boom of the late 1920s.
But George went on to write some really great songs. So.
Oh yeah, no, he did. So the board was in favor of putting direct pressure on the lending member banks, while Harrison wanted to simply raise the discount rate, which inevitably he did later that year. But the board, under Young, disapproved of the step. However, Young himself was not fully convinced either that the policy of using pressure would work and refused to actually sign the 1929 annual report of the board because it contained parts favorable to this policy. But it was on February 2nd, 1929, they released their statement, which read, "A member bank is not within its reasonable claims for the rediscount facilities at its Federal Reserve Bank when it borrows either for the purpose of making speculative loans or for the purpose of maintaining speculative loans." And so the stocks suffered a quick and swift decline as speculators fear the bull market was on its last legs. But the next day, the commercial banks came forward and lent despite the Federal Reserve. So that next day, on February 3rd, after a volatile day on Wall Street, the National City Bank of New York, which is Citibank today, defies that Federal Reserve Board's orders from that day before and announces $25 million in lending for stock market speculators. Kev, do you remember when $25 million was actually a lot of money?
Well, I was there.
Yeah,
back in 1929. I do remember that it was quite a day when Citibank came in and offered that.
Yeah, it was a big deal back then. Yeah. But accordingly, the 1929 bull market would extend another 6 months in spite of these attempts. Banks continued to lend to speculators and would keep the bubble inflated until the ultimate reckoning September later that year. And you know what, Kev, when I read the story, it's like, I can't believe what fools they were. They simply didn't know about those weekly front month call options that you could just gamma slam to the upside and not have to borrow on margin. Like, what fools, right? Like, we've got it all figured out this time. Nothing could possibly go wrong this time. No one's margin borrowing anymore, right?
Yeah, and it doesn't, history doesn't repeat or rhyme at all.
Never. Never. And anyway, that's enough. That's all I have for you.
We'll actually go back to the picture. It's also very fitting that you picked a picture where everyone looks like they're like 20 years old reading the paper for stock quotes.
Yeah, no, that's today the Reddit kids, right?
Yeah. The Reddit kids equivalent.
All right. Anyway, it's time for No Stupid Questions. We got to invite Lena on. Lena.
Hello.
Lena, how are you?
I'm good. How are you?
I'm all right. So what do you have in store for us here?
So we have 3 questions this week. So first question. This question is probably best suited to Patrick.
Oh, my God.
Hi, Patrick. I've got my stag and doe coming up next week. It's a 5-day out-of-town bender with some close friends. Similar to the movie The Hangover, except we're going to a shit town in New Zealand. There's a good chance I could die, and an absolute chance I will not be in a state to trade. I've got quite a few trades on at the moment, some of which are starting to develop into nice trades. When you go on your benders, how do you manage your portfolio?
Oh me, oh my! First of all, that means I have to openly admit that there are benders. Yeah, like I need to have some plausible deniability to all of this. So I'll talk hypothetically if I was on a bender, right? So that's a fair way to do it, Kev.
Yeah. Well, this reader or listener obviously knows you well. Clearly. The 12 days, the 12 pubs of Christmas.
Oh my God! Anyway, so I think if I was to leave on a period where I'm away from the markets for something like 4 or 5 days, I mean, I usually differentiate active swing trades versus my longer term holdings, and generally, if I know I can't watch the markets and I have like weekly or positions that need to be watched with tight stops, I tend to downsize or liquidate almost all of those, and I just hold on to my bigger, longer term positions that often have hedges or are put on with some sort of options that have some protection inherently built into them. So I usually kind of take away just simply those trades that could hurt me the most if by me not watching them. That's the way I approach it. And now, Kevin, if you hypothetically went on a bender, how would you approach it?
I think that you're correct, that you just have to take them off. There's just no doubt about it. And especially if you're going to some shit town in New Zealand where you might die.
Because I can't imagine the person that's running the estate having to manage the shit show of trades that you have no idea what you put on.
That is the worst part about dying, is that someone's going to have to look at your inventory.
I could think of a couple other worse things about dying, but your managing your stock portfolio has definitely got to be high on that list, right? Anyway, all right, Lena, what's next?
Hey guys, I unfortunately got cute with my trade on AMC and opened a call calendar spread when it was trading at $3 with the $6 strike, thinking there was no way this piece of you-know-what doubles in a week. Well, as we saw, it did that and then some. So fast forward to Monday morning, instead of closing out my spread, I get assigned on my short calls, hoping to ride AMC back down to earth, fully hedged to the upside with my calls expiring in 3 weeks. Well, my broker wasn't real happy about this and forced me to close my position. I was hoping to stay short since my risk was capped to my initial debit, but my broker felt otherwise. Why would a broker force my hand like this? Is it because I'm a no-coiner and still poor? Posting more margin for a risk-capped trade doesn't make a lot of sense to me.
Oh,
okay. So
you want to take her out?
Well, you're going to do this. You're going to tell everyone how it all works. But actually, why don't you start with that, and then we'll tell the story of when we were discussing who would take this.
Yeah, well, I mean, because the rules are slightly different for institutional traders,
right? Because why don't you explain how it works and what you would do, and then we'll say how I just completely whiffed on this.
So in the end, like when you're opening a calendar spread, then your long as the short option is shorter dated than the longer one, then they consider it just simply like the equivalent of a spread trade, and so the differential, the premium, is what you have to fork out. The problem is that
let's just make this hypothetical. The client, our listener buys, let's say, a July AMC call at $6 and sells like a March, let's say, at $6. Is that correct?
Yeah,
and then what happens is
then you have a debit, right? And so
so the client, our listener, pays, let's say, $2 for this because the longer dated call is worth more, and so he's got a debit. He pays that, everything's great, and then AMC proceeds to do just the rocket ship formation, or
and then you get assigned.
and no, it goes up to $20 or whatever, and the client gets assigned on
the shorter dated call.
Right. So at this point, you're long a $6 whatever we
protective
said,
call. Protective call against a short position in the stock, which arguably has not changed your risk profile. Right. So your risk is the same outlay, but at a retail level, they force you to come up with the margin for the short position.
Right. And so this is the point that Patrick and I argued about, because I was like, what do you mean there's no extra margin? We're going through it all, and I'm saying, like, this is exercisable into the common, so therefore you can short and with no extra capital required. And we actually had to go through on Interactive Brokers, and he had to show me, because I'm still flabbergasted that that's the way it works, because that's not how it works when you work at a dealer and you actually margin these things. So I was actually getting schooled on how. Yeah,
well, like, I mean, to use the equivalent, right? Like, if you buy a stock and you buy a protective put, they make you still fork out the margin for buying the shares, even though completely synthetically buying the equivalent call option to where your protective put is the exact same risk profile as a synthetic, right? And yet you can buy that call option with a fraction of the money and not have to come up with any of the margin, but because you chose to put it on with the stock position, it costs you that much more. And so what our listener here ran into was simply this issue where the fact that, first of all, I mean, he's short the stock. Those stocks may not have even had the inventory to be held short, so he would run into that scenario. And the second scenario is that he may have had a smaller account and simply didn't have the cash to be short the stock when it came to him. I mean, the other alternative is that you could have just downsized the position to a level where you had the margin to do it. But yeah, that's an unfortunate thing. Yeah, this is the no coiners still staying poor scenario for all us retail schmucks that don't trade institutional.
I had no idea. So I learned something from this question as well. So thank you.
All right. So last question, Lena.
Last question here. Hi, Lena. I hope you and the puppies are doing well. Thank you. We are. I have a question for the degenerates.
Oh, my God. We got a reputation,
What was your lowest point whilst trading your own account, and what did you do to turn around your P&L and psychology to recover from it? I'm looking forward to the show this weekend. It makes Sunday evening prep much more enjoyable. Thanks for all the great work.
So I'll do this one, Patrick, since you did the last two.
All right.
So I had the good fortune to go a long time without having a real downturn. Like, I went many, many years, and it just seemed to be that no matter what I did, I could figure out how to go extract some money out of the market. Then I hit a little period where I got into some it didn't go quite as well. There was a few things in terms of arbitrages that I wasn't using that disappeared, and to top it all off, we had an error in terms of at our shop that somebody did, and it was all this stress kind of coincided at one point for me. And one of the things that for me personally that was the most difficult was when I needed to make money trading, it got way worse. And to me, that was actually a real problem. And one of the things that I would say is that when you need to do well and you put pressure on yourself, it actually gets much more difficult. So the advice that I would give you is that if you need to make money, you should make sure that you take a break and reduce that pressure somehow. Because when you put that pressure on yourself, you're going to find that you trade worse. And I actually trade the best when it's almost like I don't care about
or need the money. That's weird, the irony of it.
Yeah, and so one of the things I would say is take a break. Go and just do something different. Step away from the markets. The markets are going to be here in a year. They're going to be here in 5 years. They're going to be here in 20 years. You don't need any trade to actually if you miss something, it's not that big a deal. There'll be other trades. There'll be other things that come along. And getting yourself into that mindset where you realize that there'll be other opportunities and no single trade is going to make or break you is actually the most important thing. At least that's how I found it.
All right, Kev. I really feel like you brought up a really interesting point, because I saw a really interesting observation. So I've had the opportunity to train thousands of traders over my career, and I've seen a lot of them transition from having full-time jobs and doing trading passively on the side to trying to trade full-time. And it's amazing that they would have all the success while they're trading passively, because they have another income coming in. There's no pressure. They allow the trades to happen. And as soon as they are now suddenly relying on the market for their income, and that pressure builds, something breaks often. It's amazing that transition moment is actually rather challenging, and a lot of it is psychological. The market is just the market; it's moving the same way. It's about the way we're making the decisions on an individual basis that actually that influence that, right?
Patrick, you said it beautifully. I'm going to come to you and we're going to have a little therapy session. You can tell me all the things that are wrong.
All right, buddy. Okay, so that's it for the questions. Lena, where can they send in their questions?
So if you have any questions for Kevin and Patrick, submit your questions to nostupidquestions@markethuddle.com.
Nice. All right. Kev, skin in the game. You got me, buddy.
I got you. I was so happy when you chose that. Like, I was worried you weren't going to choose that way. I wanted, because I didn't think GME. I thought the GME top was in. So why don't you tell people what the bet was and walk us through what happened?
The bet was basically as a double one touch, which is far trickier. And it was that GameStop was going to tap into close to its previous high, 475, and tap into 200. And really, arguably, Kev, it didn't do a one touch at 200 even. It just gapped right through 200. So does that even count?
Yeah,
one touch to 200.
Your prediction was 2. You managed to get 0. Very
Zero.
Well done,
it was 475, went nowhere near it. And I was like, oh, it's going to come down. At least I'm going to get the one touchdown to 200. No, it's just going to go right through 200 and not even touch it.
It still counts. It still counts. Through.
Does it?
Counts. Yeah. Oh, yeah, for sure.
We should clarify that next time.
No, it does. It for sure does. But it is funny, though, that did happen to you.
Anyway, you got me, buddy.
Yes,
you got me.
I got it. So let me tell people about this game. So before we do this, so we can figure out the next bet. So Skin in the Game is a weekly opportunity for us to demonstrate that we are degenerate gamblers at heart. Every week, one of us presents a wager, and the other guy chooses which side of the bet he wants. Every wager needs to settle by the next episode, and the currency for the wagers is as follows: a Duke and Duke, which is a crisp $1 U.S. $1 American bill. A pint of beer, a burger bet, a pitcher, a case of beer, which in Canada we call a 2-4, bottle of wine, and a steak dinner. The winner is obligated to create a new bet for the following week, and all wagers settle in full, and there will be no netting of positions. So, Patrick, I've been thinking about it. I have to come up with the bet today.
Yes.
And I am not going to do a fancy double one touch or anything like this.
Yeah.
I'm going to do just a straight up or down. And I wanted to do something we've never done before. And I didn't want to pick, bet on the same thing. So I'm going to do kind of an unorthodox one. I'm going to do, on your trade view or whatever, what do you use? Trading View?
Yeah.
Do you have the MSCI ex-US World Index? Can you get that?
The ETF?
No, we'll just do the actual index. So we'll figure out, what do you have? Pull it up and let's see. We could just do my Bloomberg. Yeah, let me do it. So I'll just do it. I'll get the quote for you. So it's the MSCI, and I'm going to tell you.
I've got this one here, which is the MSCI All World ex-US Hedge Equity ETF.
No. So that's an ETF. We're not going to do it. We're going to do the index, and it's going to be the MSCI World.
All right, send us a chart.
Index, and it doesn't matter. It's MXWO, or let me just have a look. ex-US. Up or down. So basically every other stock market in the world except for the U.S. next week, is it up or down from Friday's close?
Up.
Oh, you bugger. Damn.
It's only 1 week. If you told me 2-3 weeks, I might have actually taken it down, but I'll take the up.
Okay.
So I guess with your disappointment, we're not going very high on this bet.
Nah, we'll just do... Yeah, let's just do a pint of beer so that when we have our market huddle meetup finally, when COVID's over, we have excuse to buy lots of pitchers.
Yeah, and you know what? We have a running total now that this COVID situation. Like, normally we'd settle up these things every couple of weeks. Like, we're gonna need to rent some sort of U-Haul van or something to deliver.
We're gonna have a huge piss up, man. It's gonna be the Market Huddle piss up.
Okay, all right. So pint of beer it is. So higher or lower?
It's the you're choosing higher MSCI World Index ex-US. You're thinking it's going up next week. You're probably right. Well done, Patrick.
All right.
Okay, folks, thanks for tuning in to the Market Huddle. We appreciate you spending some time with us. Please give us a follow at the Market Huddle on Twitter. We're there every single day. Lena's manning the Twitter outpost, and she gets tired of talking to Patrick and myself. You can listen to the Market Huddle on all the networks: Google Podcasts, Podbean, Spotify, Android Play, iTunes, and YouTube. A lot of people watch on YouTube and to see all of our charts and visuals. And while you're there, please like and subscribe to get our latest content and smash the bell or something. I can never remember. And please, if you could, rate and review us on iTunes. It's a dumb game, but it makes a difference to Apple's algorithms, and it helps us out immensely. Patrick, where can they find you, my friend?
You can find me on Twitter at Patrick Ceresna, as well as you can find me at bigpicturetrading.com. Kev, where can they find you?
I'm on Twitter at Kevin Muir, or you can go check out my newsletter at themacrotourist.com. And listen, we can never have too many friends, bear market, bull market. We're just happy to spend some time together on this crazy ride. So thanks for tuning in. Now stick around for the after show.
All right.
Okay, Lena.
Good show.
Yeah.
It was a good show.
It was a good show.
So what do you guys think of the beer?
Hey, I like this beer, actually.
Really?
Yeah, I like it.
I don't like it.
I was kind of skeptical.
I thought it was a pale ale. I thought I was going to like it. I thought the Chicken Man. Listen, I'm going to give a good. I'm going to like the logo is awesome. There's just no doubt about it. It looks like me on this bike. It's a terrible outfit like I'd wear. It's just like it's awful.
It's almost as bad as the Market Huddle menswear.
It is. Having said that, I do not like the beer. I do not like it, Sam. I am. Lena, you go first before I influence you.
I liked it. I would give this a solid 8.3.
Wow.
Really? Yeah, I really like this beer. I don't know what it is.
So, you know how the other day I figured out that I like pale ales and I don't like. I thought pale ale was the same as an IPA. I don't really understand it all that well, but it seems like the pale ales are the ones I usually like. And all the beer guys are going to be like, Kev, you don't have a clue what you're talking about.
We're offending a lot of beer folk.
I just drink it, and I just tell you how I feel about it. I don't really, and I thought I was going to like it because, Granville Pale Ale is my favorite beer of all time, so I thought I see Pale Ale, and I'm, into it. And not only that, this has got, a great logo and stuff. So I'm going to give it more than it deserves purely on the logo. And just, it's just kind of
it's not bad beer.
It's not, yeah, but it's not good beer.
We've had worse before.
I'm giving it a 7.6.
That's still pretty good.
And I would be lower, but it's just that I love the logo so much.
Oh, there you go.
Patrick, what do you give your Dread Ale or whatever it is?
The Dread Hop Brewing's Round Rock IPA. You know what? Great brewery. In fact, it's a friend of mine down here that his brother runs the brewery, and it's can't believe it took me this long to find that out. And but anyway, I want to give him a plug. Listen, if anyone gets down to Barbados on the south coast, and they have a really nice bar set up, it's mostly filled with Canadians. But
there won't be any Canadians flying there anymore.
Anytime soon. That's. Let's not talk about that. But anyway, the point is, it's a good beer. I'm going to give this an 8.2.
Nice.
But I've
good solid. And and if anyone, where is it again, Patrick? On the south side,
south coast.
South coast.
Yeah, just look up Dread Hop Brewing. It's the only microbrewery on the island, it appears. Nice. So it's
support
it's
your
beer.
local brewer.
That's right.
Yeah,
I think that's just good advice anywhere.
Yeah. So
yeah.
Buy local.
If they have a good logo. So I want to give you a little update. Patrick, okay. I found the last time after the show, I didn't tell you this, I didn't know what I was going to eat, and my wife and my son found a burger place for us. And we went and picked up burgers, and I got the new burger. Every burger bet is going to this place now. It's Happy
It's that
Burger.
good?
It's Happy Burger in Little Italy. So it's down in College and stuff.
College area?
College and where? I need to know.
Oh, what is it here? I gotta find out. Lippenscott Road. Yeah, I've never. Are you? What, Lena? You don't come into the city, do you?
If I have a purpose to, I will.
Well, okay.
If I'm gonna go get a burger, I'm gonna go.
College in Bathurst.
Oh, perfect.
Okay.
My old neck of woods.
And literally, when I got there to pick it up, they're like, "Who's this old guy coming?" Because everyone was a hipster. Everyone was 25 to 30 years old. I was shocked.
I'm gonna get you a plaid shirt and a toque just so you can blend in next time you go.
And a beard. Yeah, a long beard. Anyways, great burger, Patrick. This is where we're going for all of our burger.
All right, I'm in. That's halfway between our two places, right?
Yeah,
I'm on the west end. You're on the east end. I'm
not in the east end. Buddy.
Yeah, you're center. But still, I meant the fact that that's in the center, between us. Yeah, it's a neutral meeting point.
And a big thanks. You know what? Let me just see if I can find my my email here or my Twitter. There was a very kind listener that let me know that he said north of Brooklyn was the pizza place I mentioned last time. He actually mentioned another pizza place, and I gotta find it here. It's like Costanza or something, and they mentioned it. And I was like, oh, God.
It's called Costanza?
You know what? I'll figure it out. I'll tell you by the end of the show. Lena, how are the puppies doing?
They are great. They are amazing. They're the greatest distractions I've ever had in my life. They are starting to slowly kind of walk now. They can't fully stand on their feet just yet, but they're getting out of their whelping box. They're getting around and stuff like that. So it's been great. They still look like prairie dogs though, so I'm gonna wait until they actually look like puppies to take pictures and share.
Maybe they will never not look like prairie dogs, and it'll just be in honor of the show.
Oh my God.
I think so.
Yeah.
They'll just stand on their hind legs.
That's right. They'll just jump up. And
but they are basically just cute AF, right? So it's been really nice. It's hard to have a bad day when they're around. That's for sure.
Oh, that's nice.
Yeah.
So you picked. Are you keeping the mail?
We still haven't decided. Every day it changes, like you see a little bit of a personality from one of them, and then you're like, oh, maybe this one, and then the next day it's somebody else, and it's like we're gonna wait until when they look like puppies, and then decide which one we're gonna keep.
Oh, okay.
Yeah.
There you go.
And Patrick, how's your life treating you in Barbados? I hear you have to come home.
Well, I don't know about that. Let's not talk about that. So I watched a particular show that one referred to me.
Tell us.
Loudermilk.
Oh.
Did you like it?
I did. We're over here crushing it. We're I'm on the 4th episode. I guess not crushing it really, but
it only gets better. It is so good. I can't tell you how much I enjoy it. Every now and then someone tweets me on Twitter and says they listen and they like it. I am a huge fan. I don't usually become a fanboy like this, but I'm trying to promote it because I want them to make more of these things. I love it that much.
There you go. No, but anyway, so that's what's happening.
He's such a degenerate.
He's such an asshole.
Yeah,
but you know what?
He's an asshole. He gets better. You really actually feel for him, and the characters are really real. Like it really.
You know what? The one thing about his character, it's the same character as Office Space. He didn't even change character. He just got older.
He just became an alcoholic. That's it.
He just got older and and got more cranky, a bit of more of an asshole. But it was really the same personality.
That's true.
He's like Nicolas Cage. It's like it's just one. You can put him in different movies, but it's just him.
Speaking of Nicolas Cage, he's got a series of something on Netflix. I think it's talking about swear words or whatever, and he hosts a show. The rest of the show is kind of whatever, but when he's talking, it's actually pretty hilarious and ridiculous. You should go check it out.
You know what? He hit his pinnacle when he did Face Off.
Oh my God.
It's all downhill from there.
I don't even know if all the millennials even know what Face Off is, to be honest.
It's just awesome because it's like him and John Travolta. Yeah. They switch faces. Patrick, can you imagine if you and I did that? We switch faces?
No. I could not know. You wouldn't want my face anyway.
Well, you wouldn't want mine. Maybe we could trade them in. Both of us can trade them in.
Do I get to keep my hair?
No. You gotta do the whole thing. You gotta look like me, man. It's the whole thing. So it's not just, that's true. We couldn't just do face off. We would have to do a whole scalp off.
Yeah. Let's not get into that now. It's gonna give you nightmares.
It's the scalp off.
Yeah. Yeah.
Oh my God.
This is the problem when the show runs long and I have too many beers. I dipped into after my chicken man was gone. I went in and drank one of my buddy Andy's Whitewater Brewing. I'm working on it because Andy was so kind. He gave me so many beers. So I literally am just stuffed with beers. And you know what? 50 Pips gave me way too many beers as well. I literally, I'm
sounds
becoming
like you're
alcoholic.
complaining about too many.
I know I'm
beers.
not complaining. He's a very kind guy with 50 Pips, but
I've definitely been training my liver down here. My tolerance level has.
Didn't you get a liver transplant last year?
Yeah, I did. So it was not up to par of where my old liver was. So I had to retrain it.
You traded it in for another one. Okay, listen. I found this thing about the pizza. Michael Rubin sent me a note. He says north of Brooklyn is great, but I would strongly recommend you try Conzo's. Pizzaconzo.com. So for Torontonians, that's what I'm trying next. Conzo. There you go, Lena.
All right. You almost called me by your wife's name.
My wife's name? That's true. I always tell people if you're going to cheat on your wife, make sure you cheat with the same name because inevitably you're going to make a mistake. So I'm always like, when someone wants to have an affair, I'm always like, well, what's your name? And they're like, they think some other name.
It's not going to work.
Like, can't do it.
Can't do it. Your name is
Can't
this
do
now.
it.
Yep. I have to say one more thing before we go. I was very excited to find out that there was a movie that's available on Netflix now. I watched it right away yesterday. The Never-Ending Story.
Oh my God.
The Never-Ending. Isn't that from like the 90s?
It came out 1984.
84. I was like off by a decade.
Yeah. So.
Lena, you were like 4 or something.
84 is the year I was born. So.
I'm making you older than you are. Yeah. So you like The Never-Ending Story?
Oh, it's great. It's awesome.
I've never seen it.
You've never seen it?
Nope.
Oh my goodness.
84. I was 14.
Maybe you were a little bit too old to watch that. Yeah. Maybe you were a little too
cool for that.
Yeah, you were a little too cool to watch that at that point. But it's an awesome movie.
Is it really?
No, it's horrible.
You know what?
Did you like The Labyrinth?
Let's go check. Let's go check the real.
Oh my God.
The tomatoes.
Rotten Tomatoes.
The tomatoes.
But did you like The Labyrinth with David Bowie?
I don't think I saw that either. 81. So actually, this gets pretty good tomatoes.
Sorry, I thought it was 80. Oh, 81.
No. This is 84, but I'm talking 81 tomatoes.
Okay.
Although I just clicking here and it says Pee Wee's Big Adventure got 87 tomatoes, so that's not good. Patrick, do you remember when that guy got caught?
Oh yeah, that was hilarious. Oh my God.
Was it like public indecency of some kind?
Yeah. He got caught whacking off or something in the theater.
Yeah,
or something, wasn't it?
It's like, oh God, dude, whatever. It's just what a weirdo. What did you think of that story I sent you from the Toronto Sun? Oh well, we shouldn't say what it was, but Patrick is very proud of his homeland. Well, let people figure it out. If anyone figures it out, tweet it out to Patrick and see if they can guess what story it is. Leave it at that.
We can't say it?
No, don't say it. Let people try to figure out what it was. What is your homeland? Tell them your homeland.
Slovak.
Yeah. Hey, do you have a name day? Did we talk about this already?
I don't think so.
St. Patrick's Day.
No. There's a name day.
Yeah.
I have a buddy that's Croatian, and they do this thing called
Name Day.
Name
Yeah, it's like an
Day.
Eastern European
No,
thing.
it literally is St. Patrick's Day. It's the same thing. It's the same name day.
Oh,
You have the
your
same
day.
name day as that.
Oh, your day is
Yeah.
St. Patrick's.
I think we talked
March
about this
7th.
already. Let's not talk about the same thing.
Yeah, okay.
Did you see the Screech died? That's sad.
Oh yeah, Dustin Diamond died.
Yeah. Do you know who that is,
Who's
Patrick?
that?
No.
Screech, Saved by the Bell.
Who's that? Oh. No, I didn't watch that.
Oh, was he in jail?
I don't know if he was.
I'm
in
just
jail.
Googling him, and he's got like an orange jumpsuit picture here.
I'm sure he was arrested for something at some point.
Let's have a look here. And
Last
see.
time I
Personal
heard
life.
he was in the news was like when there was like a weird sex video of him and some what's it called bachelorette party having.
Yeah, he's had some trouble.
Yeah,
he's stabbing. Okay, let's not make fun of it. Like, let's not joke about this.
But it is sad. He was only 44.
Yeah,
it's pretty sad.
That is really sad. Oh, there's the sex tape. I see it. You're right.
That was a few years ago.
Oh my God, the name is terrible. Screeched, saved by the smell.
Oh no!
Oh. Okay, let's leave the show right at that moment. That's it. That's done. That's it.
On that great note, everyone have a great week. We'll see you next week.
All right. Take care, guys. Cheers.